It'll have to be on the side, I guess, or something, because the panel table's up for good. So, is that okay? Yeah. Okay. You want to laugh? What'd you say? A laugh.
Check.
1, 2, 3, 4. Check. 1, 2, 3, 4. Check. 1, 2, 3, 4. You got it? It's out of sync? Oh, great.
So the commissioner's going to give a keynote. Everybody in the podium is.
Okay.
Is that one word?
Anybody.
Okay. Okay. Is it only that? You don't have 15 minutes. Should I just, so I can just, what do you want?
Well, we'll bring some hand mics down.
Okay, that's what and I can do that.
Okay, either way. Sure. I mean, we can
Or we
bring
can
one
do
of
it.
these
Do we have a
microphones
podium?
over.
Okay.
That's what we can do for that.
Oh, I see why.
Let's get it in. Just figure out what we can.
Yeah, okay, yeah, we can do that. Right, not till afterwards. Hello, check, 1, 2, 3, 4. I'll just walk back there. Why am I standing down here?
Sorry, it feels like there's more room over here. I got it. Thank you so much.
Okay. I'll just keep this mic back here. And then we can do whatever
Okay.
Actually, let's leave these out there.
Okay, we're good.
What's up, man? I was just seeing if I could help at all, but I guess not.
No, I'm good now. I think I need somebody to start the overflow in 288
With the YouTube link?
with Ncast. Just pull up Ncast and pull out the SDP file. All right. So now I'm going to go. Oh. Of course. My phone's dead and I can't do anything. No, I need. I'll be back, Roger.
Adios. I see the name. I'm using the one that.
Testing 1 2. 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 Testing 1 2.
Fancy.
I apologize to see you later. Hi, Joe. Hi, Joe. Glenn's face. How do you do?
Hi, Joe. Mark.
Good seeing you.
How are you?
Thank you so much.
Do you feel like I'm a lot taller? I don't.
Oh, that's okay.
Better?
Oh, boy.
I thought you have something. I mean, I have a little bun. I feel like I'm not allowed to say anything. I feel like I need a lot of cover or whatever I say. I know, I'm the same way. Or taking, I'm going to try not to take notes. I don't know why I felt like I needed to do that. I grew up in San Diego.
Oh.
Surviving?
Work today.
I believe it.
That hurts.
I believe it.
All right, ladies and gentlemen, we're going to get started. Good afternoon. Our topic today is private equity and venture capital regulation since the Dodd-Frank Act. Hopefully we're going to have a dialogue on how the regulatory environment is working and the various lessons learned. We're going to try to have this session as participatory and interactive as possible. Have any of you ever been to a program where it's just a bunch of droning, talking heads yelling at you? Anybody been there? Let's have a show of hands. Shocking that other people have had this experience. We hope this will not be that. That's our objective. What we hope to do is to tee up a bunch of questions, to have a bunch of very informed people address those questions, and to have a conversation, not only among our panelists, but we've got 2 microphones, all right? We want to be able to answer your questions. We want to be responsive to your concerns. We want to get your reaction and your input so that we really have a constructive situation where our panelists can listen and learn from you as much as you might be able to learn something from them. That's our objective in this situation. We're going to begin with a very brief series of self-introductions. Hi, I'm Joe Grunfest. I'm a professor here at Stanford Law School. I actually used to be a commissioner of the United States Securities and Exchange Commission, but I'm better now. Thank you for asking. John?
I'm John Monsky. I'm a general counsel and partner at Oak Hill Capital. I basically do M&A transactions at Oak Hill, which is a private equity firm.
I'm Erin Schneider. I'm the Associate Regional Director for the San Francisco office of the SEC.
I'm Margot Worth. I'm the Director of Private Equity at Cal STRS. We're the second largest public pension fund in the country and also the second largest pension fund in Sacramento. Sarah?
But who's counting, right?
Sarah Core, Senior Portfolio Manager at CalPERS in the Private Equity Program. I oversee risk, research, analytics, and performance for the group.
And I'm Drew Bowden. I was in the industry for 25 years, and 3.5 years ago, I joined the Securities and Exchange Commission. I'm currently the director of the Office of Compliance, Inspections, and Examinations, which is a mouthful. In essence, on behalf of the SEC, our team, about 900 people spread around the country, we go out and we conduct on-site examinations at every variety of registered financial services firm that there is.
So, Drew, since you're the most feared man in the room, right, at the moment, why don't we start with a couple of basics, all right? And let's start with the question, what's the distinction between a registered investment advisor and an exempt reporting advisor, the former typically being private equity and the latter typically being venture capital? I mean, how does this work, and what does it mean? What are the implications?
Okay, this is a tough one because we didn't want to do talking head drones, and I've been asked to talk to you about the distinction between registered advisors and exempt reporting advisors. But I'll do it my best. But first I have to give my disclaimer, which I'll give on behalf of Erin and me, and Joe, you're familiar with this, that the views we express today are our own. They're not necessarily those of the Commission. The Securities and Exchange Commissioner has 5 commissioners, and it can only act through the majority vote of those 5 commissioners. So any rule that gets passed, any enforcement action that gets brought, goes through the commissioners. Neither Erin nor I are commissioners. We also always say that the views we express to you today are our own. They're not necessarily shared by all of our colleagues in the commission, who number about 4,000. So for the purposes of your question, what's the difference between a registered advisor and an exempt reporting advisor? I'll give you the 30,000-foot level. So pre-Dodd-Frank, basically advisors to strictly private funds. So your typical hedge fund manager, private equity manager, venture capital advisor, they were exempt from registration under the Investment Advisors Act of 1940. And so from our perspective in the Office of Compliance, Inspection, and Examinations, non-registered, not really on the radar screen. With Dodd-Frank, one of the things that happened in there is they repealed that exemption. So that if you were an advisor to hedge funds, private equity funds, or venture capital, in the first step, and you managed more than $100 million, you needed to register. But the other thing that they did in that ecosystem is they passed some exemptions so that if you're an advisor solely to venture capital, you don't have to register, but you may file what's called an exempt reporting advisor. So you file limited filings with the SEC. You're still subject to the anti-fraud provisions. And I think at the time that the changes came out of the commission sort of signaled that exempt reporting advisors, again, from our perspective in the exam program, that we were going to focus on registered advisors of all shapes, investment advisors, mutual funds, other people, and exempt reporting advisors would sort of be off to the side, and examinations would occur really only for cause or for some special region. So 30,000 feet, pre-Dodd-Frank, you're an advisor to private funds, whatever shape and size, you're not registered. Post-Dodd-Frank, hedge fund, private equity, become registered, venture capital, still get sort of carved out into a special category. And so
all right, so we have 2 tribes of advisors. We've got the reporting advisors and we got the exempt advisors. Erin, from the perspective of the SEC's enforcement division, what difference, if any, does it make with regard to someone being a reporting advisor or someone being an exempt advisor? And has there been any litigation activity that might underscore that point?
Sure. I mean, just as a general matter, the SEC Enforcement Division has always had enforcement authority over the PE space and the VC space, and that's to ensure that those advisors are acting as fiduciaries and not committing violations of the anti-fraud provisions of the federal securities laws. So the types of violations that have typically fallen in those categories are failure to disclose conflicts of interest, failure to disclose related party transactions, failure to disclose fees, issues with valuation. We have brought a lot of cases in those areas already. They're the same that are at issue today. So I think what registration has changed, along with kind of the increasing sophistication of the enforcement staff by way of the asset management unit, as well as our examination staff, their private funds unit, is our understanding of and visibility into these types of advisors. You know, our examination staff has now gone out and been able to see kind of up front and close how these businesses operate, what issues they're facing. Both the enforcement staff and the examination staff have been making efforts to hire experts from the industry so that we have a much better understanding of how it's working and where the issues are. And obviously there are a lot more process-based rules that registered investment advisors need to follow, as well as exempt reporting advisors, which a lot of the VCs in this region fit into. And just one example of something to highlight, you know, to illustrate that the Commission is, you know, willing to flex its muscles in this area and taking these rules seriously. Last year, in 2014, we brought a case against a VC advisor called TL Ventures. They were an exempt reporting advisor, so the Commission found that they had violated the pay-to-play rule, which is one of the rules that exempt reporting advisors still have to comply with. They're not subject to the full panoply of rules that registered advisors are, but there are a subset of them. And importantly for this audience, the Commission also found that TL Ventures failed to register as required. Now, TL Ventures was a VC advisor, so they claimed an exemption under the VC provisions, but they had a related investment advisor that was an advisor to a private fund, which separately did not register because it was under the AUM threshold. The Commission found there that while these advisors were separate legal entities, they advised different funds, they were operationally integrated. They were owned by the same people, they were controlled by the same people, and they were operationally, the people who were making the investment decisions were the same. And so they were actually found that they should have registered. And that, I think, is important for this audience to really take a look at whether you should be registered or not. It's not that the advisors were formed at different times. It's not that they advise different types of funds or different types of businesses, but really what the advisor is doing as a whole.
So at least two takeaways over there. Just because you're exempt doesn't mean that Erin isn't going to come and get you. All right, so that's one point. Number two, you think you're exempt, but you may not actually be exempt, at least in the eyes of the SEC, once they come and look at the overall structure of the organization in which you sit. So I think those are probably two pretty important points. Now, as difficult as it may be to deal with Drew and Erin, I think that Sarah and Margot are probably the two most popular people in the room, given the hundreds of millions of dollars of assets that you have to allocate among people who are otherwise asset managers. So we basically go from yin to yang, all right? So Sarah, let me first ask you, how does CalPERS decide to allocate funds to private equity into VC, and why haven't I gotten a multi-billion-dollar allocation out of CalPERS?
So I think for any investor, it's important to take into account the fact and circumstances of that particular institution. And as CalPERS is so large, and the private equity portfolio is $30 billion of NAV and $12 billion of unfunded, it becomes really hard to invest in venture capital. So CalPERS invests where there can have an impact on the portfolio, and as such has a very small allocation to venture capital and focuses most of its allocations to buyout strategies. We have a portal where anyone is welcome to submit their proposal, and I welcome you to submit your proposal to us.
Just a second. How do I get to that portal? And Margot, in terms of your fund's operation with regard to investments in VC and PE, which you do, what do you look at? How do you do the due diligence? What kind of factors do you consider? To what extent do you look at the legal types of issues that we're exploring here?
Well, we do both. We have about 5% of our portfolio in venture. I might add, when I joined the program in 2001, the big stress was, we need more venture, we need more venture. We were looking in the rearview mirror, And then the buyouts just doubled and doubled, and I think doubled again, and became such a large proportion of our industry that has become our main focus. But we do still have about $1 billion worth of venture investments. And as I tell new people on the team, it's like a different country when you come to Silicon Valley. The rules are different. It's a different attitude.
We like that.
They'll write up an agreement, and hey,
the rest of the country, we kind of like it.
Well, it is interesting. You didn't think of this. You didn't think of this. What happens if this happens? Oh, well, we didn't really think of that. We'll figure it out later. Can you please sign the agreement by Tuesday, sort of thing. And so, but if we're going to play venture, we do have to kind of follow the customs and work in that environment. So we have the same process, the same legal review, but one in Rome.
And John, from your perspective, you really have to deal with all of these different constituencies. You've got the regulators, you've got your limiteds and your investors. So there's a certain sense in which you're beholden to everyone sitting to your right. All right. And you now have a different set of relationships that have evolved because of the Dodd-Frank regulations that have come into place. How has your life changed because of these evolutions?
I think it's been, for us, we've found registration to be a good thing. We actually registered in 2005 before Dodd-Frank because we thought it'd be better for our LPs, better for us. It was more of a policy decision, but in the short term, we saw very strong effect in terms of we increased our staffing and compliance, we increased our employee training, we increased the level of our policies. But the more interesting thing to me, Joe, is sort of over the long term, which is now that we've been registered for 10 years, which is our compliance team is embedded in the firm. So it makes both of my constituencies happy here. So they're at the investment committee meeting, they're at the valuation committee meeting, they're at the Monday morning deal team meetings. And as a result, they do a better job, and we think we avoid some of the issues that the staff has seen post-registration with firms that have had less time to really get into that culture and that mode. So it's been, we've been happy with registration going back 10 years now. We think it's done good things for us and allowed us to do exactly what you're talking about, satisfy both of these groups at the table.
So in a certain sense, the challenge that you really face, John, is not just compliance, but efficient compliance. All right. How do you wind up dealing with the very thick rule book that you've got at the SEC in a way that doesn't drown you with overhead in terms of armies of compliance people running around saying you can't do anything?
Yeah, exactly. And if you leave the compliance officer down the hall, it's very costly. Right. If they're in and everybody has this in any business, then you're going to have to walk down the hall, explain to them everything that's going on, and they're going to be working with blinders. If you put them in the room, it's very much more efficient. They can go do what they need to do. They can say, oh, we need to amend the ADV, oh, we need to improve the LPA, the limited partnership agreement, et cetera, or we need to go to the advisory board. So the key for us has been to put them in the firm. It takes a while. People get used to it. They get interactive, and they actually support the operations. But you're right on. Efficiency is a huge thing. I have a constituency that cares about efficiency, and my investors, and doing it quickly and well.
Yeah, and just as an aside, for many of the reasons that John pointed out, if you're really going to have a good compliance function, it actually turns out in many ways to be cheaper to run a good compliance function than to run a bad compliance function once you look at the costs all in.
It's not even close.
Right.
Yeah, not even
so,
close.
Drew, let me take it back to you. What observations do you think the SEC has about private equity advisors after having conducted a very large number of exams over the last couple of years? And if you could summarize, dare I use the word mistakes, let me use the word issues, challenges. What are the types of issues and challenges that you've seen come up most frequently in the private equity space that give the SEC examiners a little bit of agita, if you know what I mean?
Okay. well, some of this will be reviewed for some. We actually gave sort of a public statement about a year ago, I think last April, in terms of our observations from our examinations that we had done in private equity. And I'll just recap briefly, because you can go read that if you sort of want to go by the blow by blow. I'll recap briefly at a high level sort of what the major observations were. I think at the beginning, sort of two of the misunderstandings as private equity funds became registered and we went out to do exams. So some of the questions that I usually get is sort of why are you picking on private equity, and why have you tilted sort of your exam program disproportionately to private equity? People sort of ascribe to us, well, you don't like the 2 and 20 fee structure, you don't like monitoring fees, you don't like the collection of transaction fees, and so the SEC is out there because it doesn't like these fees. And I said, well, that's not true at all. I think at the SEC we recognize, private equity has done a fantastic job for investors. It's delivered really market-beating returns compared to any other asset class over the last 10 years. So what we're really focused on in the exam program is not any particular policy or other political type agenda, but simply we're focused on transparency and disclosure. So where our exams really start is focusing on people like Margot and Sarah are negotiating with private equity advisors or venture capital advisors or hedge fund advisors for a deal. And so our examinations typically begin and end with, what did you tell your investors you were going to do? And then our examiners have the ability, unlike I think Margot and Sarah and their team, we can go behind the curtain and talk to people and look at documents and get whatever we want. And we're trying to answer the question of, okay, so this is what was promised, now what was delivered. And so we're really focused on the disclosure, the transparency, and whether there's alignment. What we've seen, again, at a high level in terms of our exams of private equity is we saw disconnects, what I'll just call non-compliance, right? Non-compliance with the terms of the deal, really in three principal areas in private equity: are fees and expenses. Sort of what fees am I allowed to collect, and how do expenses get allocated as between me, the manager, and my fund or other side investors. Two is favoritism, or how do investment opportunities get allocated amongst different funds, amongst people in the fund and people who may have co-investment opportunities outside the fund, including the principals of the firm. And then third, valuation. How is valuation actually conducted? So I'll maybe stop there for 1 sec and use that again as an example of what I'm talking about. I think a lot of people misperceive on valuation that our examiners are going to come in and challenge people and say, well, this private company is not worth X. It's worth X minus 2%. And so we're going to challenge you on the merits of your valuation. We're not doing that at all. That's really not a good use of our time. I think having been in the business, valuation sometimes is a difficult, reasonable people could deliver. Rather, what we're doing is we're simply asking people the question of, how did you tell your clients you're going to value their investments? What is the process that you told them you were going to follow? And then is that what you actually applied? And so where I would say, on those types of issues, we're not painting a Vermeer. We're not there with a one bristle brush doing fine coats. I say we generally are painting, with a 4-inch brush in terms of what we're doing. But where we see problems in valuation is, I told my clients I was going to use a particular valuation methodology, and I didn't. I used a different one. Or I switched my valuation methodology from quarter to quarter or year to year in terms of what I do. So those are the types of things that we saw: fees and expenses, allocation of investment opportunities, and valuation, I would say, at a high level in that particular business model.
So I believe there's a law of thermodynamics that says if the Office of Examinations finds a problem, then the enforcement division will sooner or later find a cause to litigate. Is that about right? Is that about right, Aaron?
That can be right in certain situations, Joe.
I would say
that's why it's like a law of thermodynamics.
About my stats, so I say, we like to go on data. As it turns out, in our examinations, our program refers about 10% of the examinations we do to the enforcement division. So we find deficiencies about 85% of the time. That's across the whole industry, right? If you let my examiners in any of your shops, we can find a deficiency of some magnitude or another. So deficiencies 85% of the time. Referrals to enforcement, where it's significant enough where we say, hey, wait a minute, this ought to go to our colleagues, about 10% of the time. And then once we hand it off to them, it doesn't mean there's going to be enforcement. It just means Erin and her team are now going to review what we found and make a determination on behalf of the commission. is this a good use of the commission's resources to bring enforcement action?
So Aaron, when do you come down heavy?
So I don't have stats like Drew, but it is true. I mean, there is a subset of the deficiencies that are referred to of enforcement, and then there is a subset of those referrals that enforcement actually investigates and makes a recommendation to the commission. I thought it would be helpful to talk a little bit about what I look for as an enforcement person when I have that referral in my hand. OC and I do work collaboratively, so OC enforcement are working collaboratively, discussing these issues all the time. I think generally speaking, OC will identify a deficiency, and we really want to get to the bottom of why this happened. Was it an intentional act on the behalf of the people that work there, or was it some sort of widespread failure? Just because it wasn't an intentional act does not mean that enforcement will not be interested in pursuing it. I think sometimes just wholesale or failure to pay attention to certain compliance-related areas can end up causing a lot more harm than an intentional act. So that's something that we'll be looking for. And then just, who really was responsible for it? I think we have a mandate from our current commission to hold individuals accountable, and that's something that we're looking for. Was this a particular person's fault, or was it just a broader process failure that nobody can be held accountable for? And then, there are certain issues that we think the commission needs to speak publicly about. The examination findings, the deficiency letters are issued to the firms. Firms may or may not pass them along to their LPs when they ask for them. I'm sure that several of you in the audience will cringe at this, but we don't have enough resources to go out and look at everybody. We really depend on some sense of a public-private partnership to, get the industry to police themselves, which I think has benefits for everybody at the end of the day, as John was mentioning. So just briefly, these are, 3 things I look at. Are you acting as a fiduciary? I think a lot of times we hear from advisors, our interests are aligned, and I'm not sure that that is the same thing in certain situations. I can just make up an example, but, a fund that you're advising needs cash, or portfolio company needs cash, the fund doesn't have it, and so the advisor makes a direct loan without running it by the advisory board, without telling anybody about it. The advisor may say, this is in everybody's interest. I'm not sure that's the same as being a fiduciary. Number 2, do you have well thought out, documented policies and procedures that you're following? And 3, are your fees and expenses really actually disclosed to the LPs? I think we hear a lot that LPs know exactly what's going on in this business, and I don't think that that's consistent with what we hear when our examiners go out and talk to LPs, or when enforcement goes out and talks to LPs as well. So just to highlight one case, just as an example, we brought a case last year in 2004 against a PE advisor called Clean Energy. This was a case where the GP had allocated a bunch of improper expenses down to the fund level, things like GP salaries, GP benefits, rent, a wide variety of things that, as you can imagine, shouldn't be borne by the fund. This particular GP had policies and procedures, actually saying that these types of expenses were prohibited, so a pretty egregious set of facts, which is why enforcement action was brought. But you can imagine that this can happen in more nuanced ways. I think Drew has spoken about this, and there's been conversation about, consulting people that provide advice to the portfolio companies that used to be paid by the GP are now being pushed down to the fund. Valuation services that used to be provided by the GP in-house are now being automated. That's being pushed down into the fund. Reporting mechanisms that used to be borne by the GP are being pushed into the fund. So there are more nuanced ways that this can happen, that you can get into trouble from an enforcement perspective. And then I just wanted to give you a sense of some of, we haven't brought that many cases in the PE space since Dodd-Frank has come. I think you will see more. I think you will see them in the fee and expense area. And I wanted to give you a sense of just what we think about in enforcement. Our funds, our advisors offsetting against the management fee all the fees that they're getting. I think there's a general sense that this offset provision helps everybody and benefits the LPs, but I'm not sure that all of the necessary fees are being offset. Our advisors creating new classes of fees to avoid the offset. The acceleration of monitoring fees, especially when coupled with an evergreen provision that will accelerate those fees beyond the initial life of the fund. I think enforcement will have an interest in that. And I think that'll give you a good sense of what we're looking at. I think you will see more cases in this area over the next year or so.
All right, so if I'm to understand our friends from the SEC, they're basically in business to protect Margot and Sarah from people like John. Is that about it? That's what I've just heard. That we need to protect them from predation, all right, by people like you. So that's about what you've said, isn't it? I mean, I'm not paraphrasing too badly. So let's first go to Margot and Sarah, and then we'll turn to John. You know, Margot, from your perspective, how transparent do you feel the fees and expenses are by the GPs? Do you feel there's stuff going on there that you don't understand? Because the story that I've heard is we're not telling anybody which fees they can charge, and we're not telling them how can they describe the fees. We just want to make sure that the LPs understand what's going on, and the GPs are following the rules that they've agreed to in the deal with the LPs. So how comfortable are you with regard to disclosure and transparency in this space?
Well, I think there's been a lot of improvement, but it still has a long way to go. And I'd just like to go back to, say, 2008, which isn't that long ago in private equity. We're in 15-year funds. That's not that long ago. And the industry, again, was doubling, and there were $5 billion funds. Then there were $10 billion funds, and 2 years later there was $20 billion funds. And so we would negotiate with the firm, and they would tell us we're going to get full disclosure on all fees and expenses. We would show up at the advisory board meetings once or twice a year, and there'd be a 1-hour meeting. The GP would go through and tell us about developments at the firm, maybe discuss a conflict issue. You'd start to hear the rattle of dinner being set up in the next room at 6. It's about 15 quarter till, and this is and you're sitting there as a LP, and you look to your left, and there's 1, 2, 3 GPs, and then there's another LP, and you look the same way. You've been separated, and they make the disclosure, and it's fully disclosed. It's portfolio monitoring fees for the year, X million, transaction fees, X million, and it was 4 numbers. And the industry suffered from the excesses, and when the economy went down, the industry suffered, and so that has been a main focus. And so the LPs got together and started demanding more transparency, and one of the things we asked for was in-camera sessions. And so now what we insist on is after we have the meeting, we ask the GPs to get lost for an hour, and we talk, and then we come back to the GP and say, we really don't like this disclosure. We want it by company, by year, and cumulative. And so I think there's still a lot to go, but I think the combination of the LPs standing up for their rights and the SEC going and digging in deeper than it's really difficult for any one LP to do is changing the industry. But
there's
still room for improvement.
Is your experience similar to Margot's? Would you like to see more uniformity in the industry? Would you like to see the use of templates? How do you see ancillary fees impacting funds? All these other miscellaneous. I mean, you run a huge pot of money. And it's fascinating.
It gets charged a lot of fees.
Yeah, and it's fascinating that for putting my professor's hat on for a second, you're probably the largest and most sophisticated set of investors in the world. And yet, what we're hearing is you can't fend for yourselves. That in your negotiations with the GPs, either at the VC firms or at the private equity firms, you're still not able to get what you think you want or what you think you deserve, and you still need the protection of the SEC, just like you're a retail investor. What's going on here?
Yeah, I would say we have, at CalPERS, had similar experiences to Margot on transparency of fees. CalPERS has required the general partners to use the ILPA template for capital calls and distributions for 3 or 4 years now, and we get pretty good compliance with using the template format. Where we do run into problems is using all of the data elements within the template properly. So quite frequently we have to go back out and ask again for what was the gross management fee, what was the offset, what's the corresponding net management fee. So they're putting it in the template, but they're not disclosing all of the information that we're hoping that they do. So that's an area where it requires a lot of staff time to go out each time you get a capital call for management fees and ask for the additional information that there is required to be disclosed in a lot of the partnership agreements that we have. So we do spend a lot of time trying to get that information, and a lot of experiences at the advisory board level where they're required to disclose maybe 2 or 3 types of fees in the agreement, and there might be 4 or 5 that they're charging. So you don't get disclosure on the fees that they're not required by the agreement to disclose. Some of the things that we do is we send out our internal audit and our compliance team to do reviews to make sure they're complying with the agreement. Actually, Brian McQuaid is out there, and he does some of the compliance reviews for us. But it's challenging, and GPs aren't as transparent as you would like them to be.
I would just like to add one thing about the leverage. Some of the firms, a lot of the firms stumbled in the global financial crisis, and some of them were injured and could not raise funds or had a hard time raising funds. And in those situations, a firm like a CalSTRS or CalPERS could say, okay, let's start with a clean sheet of paper. We might be interested. We think we saw what happened. We think you still have talent, and we could really move the needle. But some firms went through the global financial crisis and returned 25% net. And so when those firms come to raise another fund, there's people lined up behind their door. And in those situations,
so people will actually pay for good performance.
They'll pay.
So is that the problem?
It's a market mechanism, and so you might feel like I'm willing to pay a higher fee to be in a higher performing fund, but they might say it's higher performing, more fees, but also you can get lost on us changing the agreement. It was good enough in 2007. We've read everything that's gone on in the press. We know you'd like better disclosure. We know you'd like more clarity, but we're closing, and we hope you're in, but you can take it or leave it.
And so let me ask a bold question. What's the matter with that? I get take it or leave it deals all the time.
There's nothing. Well, I think, and in cases we've said we'll leave it.
Right. In other cases, you
but
said we'll
I think in other cases, people have taken it, and that's fine. But you wonder whether they're giving you a fair deal. You wonder, are they charging fees in excess of what the deal was portrayed?
Which goes back to the SEC's question of you can cut whatever deal you want, and the only thing the SEC says it's interested in is whether you're abiding by the deal that was cut.
I think we are fine with that, but that's why transparency is so important.
So, John, if I'm to take these 4 people seriously, you and your type are the source of quite a bit of problems over here.
It's the other guys.
You don't seem pathological, but what's changing in the industry since we've had the SEC on the beat, more aggressively? We've got the Dodd-Frank Act. How is the private equity in the VC space changing its business practice in response to these regulatory forces and also pressure from litigants?
Look, I think that you're seeing a very good effect. For these people that I talk to, there's more disclosure in the ADVs, there's more disclosure in the LPAs, the PPMs are better, and Margot and Sarah are having a good effect, as well as the work of the staff. And I think the other thing, the point that Margaret makes with the advisory board is really important. For us, the engagement of the advisory board is great, because if we can engage with the advisory board on a substantive level, and it's very important to us. We use the advisory board a lot. Aaron's a lot happier, and we like to keep Aaron happy because if we are able to say, well, it wasn't entirely clear, there was a conflict, we went to the advisory board, we discussed it with a sophisticated group of LPs, they said yeah, and sometimes they say no, and that's fine, and other times they say yes. That makes Aaron a lot happier and saves Drew a lot of time. So everybody's good, back to efficiency.
So basically the idea is if an ambiguity comes up, because when you write a contract, you can't anticipate every contingency that arises. You've got an expense, for example, you say, I don't know, does it fit here, does it fit there, how much of this do we eat, can we keep this, do they have to absorb that? You call together a group of representative LPs, you present the question, you get their view, and you reach some kind of consensus. And is that kind of an approach persuasive at the SEC?
I mean, I think in general contours, yes. I think that the SEC would draw some comfort from advisory boards. I think where we've seen the advisory board issue fall down are sometimes it's not clear to me when I read the LPA agreements, and I don't know if Margo or Sarah have a different opinion, but it's not necessarily spelled out which types of transactions have to be run through the advisory board. Is it just, if a certain person deems it a conflict, do potential conflicts need to be, like what types of conflicts actually need to be run by these boards? Because a lot of times the examiners go in or we go in and there are a whole host of conflicted transactions that have not been run by the board. I also have some concerns, make sure those advisory boards, and as Joe, you've been describing it, it's a group of sophisticated LPs, but make sure those advisory boards themselves aren't conflicted. Like, does anybody on that advisory board own a piece of the GP? I think that there could be leftover structures from periods and other times, but it's just something to think about. So generally speaking, yes, I think we would draw some comfort from the advisory board, but how is that functioning in practice will be a question.
Well, Aaron, you've raised the issue of conflicts, and Drew, you're out there on the street, and one of the things you're hunting for is conflicts. What kind of conflicts are you finding, and what can PE advisors do to address some of these concerns around the types of conflicts that you're discovering?
I think in terms of some of the broader general kind of conflicts that we run into, our allocation of co-investment opportunities. So a not uncommon examination topic, I'll say, is many LPs get side letters offering them co-investment opportunities. So if I'm a general partner and I've offered, pick your number, 4, 5, 6, 10 LPs co-investment opportunities, and it appears that all of them are going to be offered opportunities equally, well, we'll come in and examine and say, are you in fact presenting opportunities to everyone equally? Or do you present opportunities to your largest investors sometimes and not to others? And again, on that one, that's another one where I sort of say, you can allocate co-investment opportunities however you want. You could do it A to Z and start again. You could do it randomly. You could throw darts. You could say, I'm going to allocate co-investment opportunities to the people who I think are going to give me the most business in the future. Like all that. But that's what you have to tell people, right? You can't have letters out there that promise everybody a square deal and then pick and choose as you want based on. So co-investment, cross-fund and co-investing across funds. So selling one investment from one fund, an older vintage fund, to a newer vintage fund. A big conflict on either side, right? So you have to have a good process, I think, to make sure that that transaction occurs at a fair valuation. Related party transactions. So setting up third-party service providers and requiring your portfolio companies to do business through a certain party. Dual employment. So we talked in the talk last April about operating partners was a good example where I think they were in many cases presented as employees of the firm, and you assume that they're being compensated as part of the management fee when they're not. They're being charged back to the portfolio companies. We've seen legal department bills at the general partner level allocated down to the portfolio companies, again, without proper disclosure, right? If you want to, that's the way you want to run your business, and you have the leverage to do it, but just be square up and straight up with your investors about it. Fee allocation policies and procedures, we talked about that some. Advisory board involvement, and we've talked about that. That I would say is another area in the conflict, not uncommon in our exam program, where I would say up front when the relationship's being formed, an advisory board can be a good mechanism to get LP feedback on conflicts and how to resolve them. So there are certain promises made about when the advisory board will be consulted on what kind of transactions and what type of situations. And again, what our examiners do is come in and say, well, are they in fact being consulted? Or are they being consulted some of the time and not all of the time? Or are they being consulted on the little issues but not on the big issues? And so we see conflicts there. Valuation is one I already mentioned too, I think, where there's, you know.
All right, so let's test our law of thermodynamics here, where the Office of Examinations finds an issue. That just means that you're going to get a reaction from the Enforcement Division because they're going to bring a lawsuit. Has that actually happened? I mean, is our law of thermodynamics here actually working?
I think it has happened.
Yeah,
yes,
okay.
I think it has
That's
happened.
a sign. And have you got some examples of situations that have arisen to a level where you actually bring an enforcement action because of what Drew and his people find?
We have. I mean, I think just to echo what Drew has said, I mean, conflicts, they're just a big part of the business in the PE world. And they are there. We recognize that they're there. We're not saying that they can't exist. It's just, how do you manage them? Have you thought about them? Have you gotten advice about them? What do you have in place to make sure that you're managing your conflicts appropriately? I mean, I think especially for the bigger PE advisors, I mean, there are a multitude of people that are coming next to, around these funds, right? I mean, you've got the LPs themselves, you've got co-investor vehicles, you've got proprietary vehicles, you have maybe credit funds investing alongside. There's a lot to manage there, and I think you will do yourself a real service by getting advice about that.
We've got questions from the audience.
Yeah, I'd like to ask a question.
Would you like to step to the mic? Because that way we'll have the question.
Regarding conflicts of interest, it's very common in LPAs for there to be a statement that says effectively that the general partner may transact with affiliates so long as the transaction occurs on an arm's length basis. And I wonder, when you and your teams see those situations, it seems like that's like my head explodes just inherently, because can a general partner transact with related parties and have it be at arm's length? Can you ever meet that standard, transacting with an affiliate, or or do you just inherently scoff at that and say that you can't? And I think it's an important question because it occurs all the time in LPAs.
Yeah, I don't know if we scoff at it, right? And I think we're always making the distinction between process and outcome, right? I would argue that in a conflicted situation where you're going to do transactions with an affiliate entity, you are facing a material potential conflict at the least. And so what you'd hope to see is a matter of good process, that there's some mechanism in place to ensure that it's done on an arm's length basis. In the absence of any process there, I think sort of the burden might become higher. But I think what you're going to do is look at the outcome, and theoretically speaking, I could see an example where you say, I'm going to do business with an affiliated an arm's length basis. Our examiners come in and they say, well, this affiliated entity was providing this service at this price. We've sort of looked around, and that looks like the market price for that service. And I think as an examination function, we might say, well, that's a really lousy process about how to handle the conflict, and it leaves them open to be second-guessed, I think, in terms of what they do. But at the end of the day, it appears to meet the standard that was promised, in essence.
So if we borrow a principle, say, from corporate law, if you've got a conflicted transaction, the courts are going to look at it and apply something called the entire fairness doctrine. And it's then your burden to be able to demonstrate that the process that you used was procedurally fair and substantively fair. Procedurally fair, you did something like you went out and you did a market check, all right, and you know what the other prices are for other transactions that really are arm's length. And substantively fair, you picked a price that was in a zone of reasonableness of what you find when you go out and you do the market check. Now, I shouldn't say obviously, one can imagine that not in every situation that comes up, people roll out all of that machinery, all right, in order to demonstrate that the transaction with an affiliate was procedurally and substantively fair. But if you don't roll out all of that machinery, you take a certain element of litigation risk. all right, at some level, you know, the SEC may come out, may look at that and say, well, wait a minute, on what basis do you reach the conclusion that that was a fair arm's length price? And if you're not able to support that conclusion, you're going to be more at the tender mercies of the agency than if you've got a documented record as to what you did.
Yeah, it gets interesting actually, because you see in many Form ADV Part 2 statements about these transactions, which but for whether they were arm's length or not would be prohibited, where you see actually the advisor actually is actually conceding in the ADV that these are not arm's length transactions, and so it just seems like there's the tension there seems to be actually very, very high, and so that's just my observation and curiosity.
And maybe sort of a related theme to your question, I would say that's probably closer to what we see more often are clauses that say, you know, the general partner may allocate certain administrative and operational expenses to the fund. It's pretty broad language, right? And so sort of, Joe, to your question about take it or leave it and everything else, you know, the one important, I think, fundamental building block in ours is the advisor is a fiduciary, right? So it has the burden of describing what the deal is to the client in a way that a reasonable set of investors could fairly understand it. So in certain instances, when you have that vague language, you know, if it's a legitimate, you know, you sort of look at it and say, well, that seems like a reasonable person would think that's an operational expense. Or you come into a private equity firm and you realize that after the deal closed, they took their entire research team and their back office and everybody else, and they charge it now back to the fund, and they don't carry any of that cost as a management fee. You say to yourself, well, would a reasonable person understand that as the terms of the deal? And I think in some of those instances, I think we're left to say, I really don't think so. And if you bring it back to where I started, then you say, okay, well, the fiduciary, the advisor, is the one that has the burden to describe what the deal is to the client. And here there's clearly material economic elements of the arrangement that were not fully or fairly disclosed, such that, sort of, Joe, to your point, they could fairly understand what the deal was that was being put to them on whatever basis, whether it's take it or leave it, or, you know, take 6 months or whatever.
So you know, again, John, the longer these people talk, the deeper the hole is that you guys wind up finding yourselves in. So do you have controls that you use to put in place to address these potential conflicts? You know, how do you do that? And just as a side, one of the things that I tell people, not just about Silicon Valley, but about large swaths of business, all right, in the financial markets and elsewhere, conflicts of interest are common, all right? And there's nothing ipso facto wrong with a conflict of interest if it's properly managed and disclosed. So there are many situations where you can't avoid a conflict. There are many situations where a conflict actually generates many, many benefits, but you got to be aware of it and you have to manage it appropriately. How do you guys go about that?
There's the higher level stuff and there's the more granular. In the higher level, I think Drew's absolutely right. You know, one morning I came in, our compliance department had replaced our mouse pads, and the top line of the mountain was the 10 lists of 10 compliance rules to keep in mind. So, you know, my kid's mouse pad was gone that I got from grade school, and the top rule was think like a fiduciary, act like a fiduciary, be a fiduciary. And then everything else was ruled, you know, specific rules about, you know, political contributions, the whole thing, all the rules, the big rules that you have to worry about. But that top rule has got to where you have to start, because there are going to be ambiguities. And if you start from that point of view, which is, and the sequence that's important, you know, think, act, and be, that's got to be through the firm. And then the second thing that we found is very important is, and that you need to be obviously a bigger firm to do this, but committees are great at spotting problems and mistakes. So the bigger issues, particularly conflicts issues, we have a compliance committee. You'll want to run it through the committee, because if you look at all the studies, I mean, we're at Stanford, this is a place where great inventions happen. Individuals are great at inventions, but committees are terrific at spotting problems. And I think we see that a lot, and so you have a good committee structure. And then from there we go down to more granular stuff, which is our regular compliance programs. We do quarterly reviews of the topics that he cares about and Aaron cares about, and we don't let it build up to the end of the year. So all of that works. And then the last two pieces is really good integration with accounting, because a lot of these conflicts do run around dollars and where dollars flow, and you got to make allocations. Accounting has to be in the room to make Margot and Sarah happy, to make sure things are allocated right. If they're not in the room, they don't understand where they're putting stuff, allocating expenses to co-investors and so forth. It's really at accounting, so we spend a lot of time with accounting. It's not just compliance.
You know, what I'd love to do is open it up for questions from the floor. Yes, sir, come on forward.
I'm a retired VC. My wife might say a recovering VC. I'd like to ask about the thing that I think the most controversial thing that CalPERS has done in recent years that I happen to agree with, but none of my colleagues do, and that is calling for the abolishing of the carried interest. And for those of you who aren't familiar with the carried interest, it's a fiction by which people in private equity and in venture capital take long-term capital gains, pretend that their income is long-term capital gains, and it is a way to run up the federal deficit for the wealthiest people on the planet. And CalPERS called a few years ago saying, hey, guys, enough is enough. I wonder if anyone else has an opinion on that and thoughts on it. And of course, a piece of this is what bucket you put some of these fees in it turns out to change the tax treatment, and it can run into millions, and for some individuals, tens or even hundreds of millions of dollars of shifting tax dollars around.
I think that's a question for CalPERS and CalSTRS probably.
And I'm sorry, you said abolishing. Do you mean abolishing the tax treatment on capital, on carried interest, or?
So carried interest is now treated as long-term capital gains.
Yes.
And the call was that it be treated as ordinary income, not long-term capital gains.
I have a very, very, very strong opinion on that. I don't think my opinion matters. I mean, it's a matter of tax policy and equality and you know, who should be paying taxes in the country. But as far as being a fiduciary to our beneficiaries, you know, the tax code is what it is, and we want our, you know, we're evaluating performance. Sorry.
Sarah?
CalPERS actually doesn't, well, we haven't taken a position either way. It's up for the government to figure out what they want to do tax-wise with carried interest. You know, people may have views at CalPERS about that, but CalPERS has not taken an official view that it should be treated as income and not capital gains.
We have some other hands. Yes, sir.
This is very interesting talk. Not, everything else being equal, conflict of interest, regulatory issues, transparency, would a GP that puts some co-investment be, from a regulatory point of view and investor point of view, be more or less comfortable in the role? What I mean is that if a GP is acting purely as as a general partner without any aligning of interest with cash invested, does it make any difference?
Makes a huge difference. But sometimes, in theory, it makes a huge difference. If you exaggerate it in somebody's, say, left a large firm and is worth a couple $100 million and says, I'm going to put a couple $100 million into the fund and I'm only going to raise $800 million, then that's somebody, all other things being equal, you want to be partners with.
Yes, but yeah, here
Was that the question?
Yes, yes, that is the question.
Else who says I'm going to put in
4,
1%, and by the way, I'm going to do something called fee waivers. Not actually put anything in.
Okay, so symbolic numbers don't
Well,
make much difference.
And it's just one. You know, it's just a small factor. If you look over the lifetime of a fund, if they're taking 1.5% a year during the investment period, and you look at all the fees, you might say over the life of the fund they're going to take 14% of commitments. And so one person says, I'm going to put 2% in of commitments as my co-investment, and another person might say 3%, and you do some math and you realize, well, both of them, depending on how many people they hire, are basically taking your fee to pay for their GP commitment. So, you know, I'm always a little cautious for someone who says, wow, this one's putting in 3 and this one's only putting in 1. May or may not be significant.
Asset class, does it make any difference? Real assets versus financial instruments?
I think the principles apply. I mean, in general, buyout firms tend to put in more, but you know the same principles apply.
Got another question, Mr. Schatz?
Hi, I'm JD MBA here at Stanford, and this has been great. Margot, you alluded to the fact that in 2008 there was a shift seemingly in bargaining power between LPs and then the remaining high-performing GPs. With the not-so-secret growing pension obligations that most states are facing, are you under increasing political pressure that is further driving a diminished bargaining power for you when you're dealing with GPs? That's because you need to sort of see certain returns that only alternative asset classes can provide. So that's my intuition, and could you confirm whether that's right? And then the second question would be, for the SEC folks, are you seeing more egregious or more frequent violations post-2008 as you've seen a shift, if it does exist, in bargaining power from LPs to GPs?
I would say, I'll go back to 2000, and I would say, wow, this was a great asset to be an LP in. And the day I walked into CalSTRS was a very good day in my life. And it was, you know, if you were in the LP, if you were in the private equity asset class at a public pension, you were a hero because you were knocking it out of the park. But the industry has matured and become more efficient, and it's made it harder to make a return, and it's still growing. And so I think we are not under pressure to put out more than we think is comfortable, but the value proposition has changed. It's you know, a lot less certain now that you'll be able to make out returns. I mean, for a while we were outperforming public markets by 10%.
For CalPERS, CalPERS actually decreased its exposure to the private equity asset class from 14% to 12% about a year ago. So while CalPERS is underfunded and there is a desire to have a higher funded status, and private equity is the area where alpha is expected in the portfolio, it's not driving us to increase the exposure to private equity.
Other questions?
I think, can I chime in on the regulatory end, so your second part of your question? So it's several too, and one thing I probably should have said at the beginning, you know, in terms of sort of egregious violations and those sorts of things, I mean, one of my observations is always too, I think we shouldn't get lost in the fact that most of the people in the industry are really trying to do the right thing by their clients, by their employees, and, you know, by our markets. And so we tend to focus in the exam program, we're focused on deficiencies, not on what people are doing right. So I'm always a little bit leery when you come up and talk about these things. People leave with the impression that, you know, it's a cesspool of misconduct. And I think for the most part, we certainly do see misconduct. Sometimes it's egregious, but I don't think it's fair to sort of paint, you know, the whole industry with that. In terms of your specific question, in terms of changes since 2008, again, the private equity firms in particular didn't come online for us for examination until like 2011. So we've been doing exams for about 2, maybe 2.5, going on 3 years. And we really don't have enough data to make any conclusions about the way things went. I think, what we're seeing from our position in the market right now is since registration over the last couple of years, our sense is, and I wouldn't say it's directly attributable just to us, right? I think it's a lot of issues. I think it's work by the limited partners. I think it's other things. But what we've seen, I would characterize generally as kind of directionally correct in terms of improvements in disclosure, more proactive inquiry, focus by the limited partners in terms of what they're doing, and other things. Again, I don't think any of us are ready to blow the all clear whistle and say we're moving on, and we're not going to look there anymore. But that's a high level overview. Hope it's helpful.
Thank you. My question is specifically more about venture capital and how some of the concepts that you were talking about earlier in the talk, not to fees, but more about valuations and pragmatic and efficient financial strategies for investment, how those factors are looked at both from a regulatory standpoint and an institutional standpoint in the realm of venture capital, where the data is all over the place and the valuations are kind of crazy from a quantitative standpoint, and where the fundamentals are looked at in a very different way. So how does both the SEC and both like an institution approach their agreements with venture capital funds that are investing in technology?
First, go ahead. Mine's easy. I'll do it first. Let's come right back.
Okay.
Ours is just what do you tell people you're going to do in terms of valuation? How do you describe to them how you're going to make those sometimes, admittedly, difficult determinations? And do you follow it? Is that what you're actually doing? Or are you reverse engineering particular results or not following the process that you disclose to your investors?
And there has been certainly some academic literature on this subject, but I think it may hit the VC side of it more, just because the valuations are going to be more difficult given the level of data that you have. But just, are you changing your valuations in times of marketing? I think there's this sense that valuations don't matter till the end, but I think that there's certainly some talk about the fact that firms may be marking up their valuations when they're going out and fundraising and then marking those assets back down. So just really being conscious of what you're doing at the time, who's involved in the valuations. Do you have a marketing person sitting in on those committees saying, can we just go a little bit higher, things like that.
Sarah, Margot, valuations, venture capital?
The valuations, they're going to be extra subjective, and especially in early stage. These are maybe pre-revenue companies, and it's just highly speculative, and maybe there's subsequent financing rounds which might indicate some third-party collaboration, but even that can be suspect. So, with more uncertainty, you have to filter that in, and you might have two firms whose previous fund are both at 2x capital, but one might be have returned 100% of your capital, and it's another 100% in terms of unrealized in valuation, and another one might be at 2x and only be 25% of that's actual in the pocket. So you're going to give a lot more credence to the realized returns. But and you would also look at the hopefully longer history of the firms and seeing what their valuation practices are, and look at patterns of valuations as they get close to fundraising. And
so if I understand this correctly,
maybe spot check a couple of them. And
you give some leeway in the case of venture capital because kind of the academic literature is kind of nebulous and the financials are also very different. You kind of leave it up to the fund to make effective choices.
Well, when it comes to valuation, the general partner is used to be agreements would say that we're going to value a certain way, and different funds would value different ways. But now the accounting standards are such that if you're audited, you have to value on a fair market value basis, which also doesn't necessarily tie it down, but typically we're presented the data and we have to interpret it the best we can.
All right, time for one last question.
Thanks for your questions.
We've got one all the way in back. Come on down.
This is maybe a question more for the LPs, but it seems that one of maybe the unintended consequences of the new regulatory regime seems to be that it favors the scale economies of a large fund versus a smaller fund because of the fixed cost of compliance. Also because there's, with the transaction fee offsets, there's kind of less money there for the smaller funds to afford groups like operating partners and people like that. And it would seem that, again, one of the consequences could be you will find over time less innovation, less creation of smaller GPs to the favor of the larger GPs because the economics of the industry, because of all these fixed costs and changes in transaction fees, are favoring the larger GPs. And I'm interested from an LP perspective how you view that.
I mean, I think the answer is yes and no. That the large firms have tremendous infrastructure and they have a tremendous advantage and trade name value but you know, smaller firms and also I mean a tremendous salary load. I mean they. These are behemoth of organizations, but you know, a smaller firm can be nimble and can operate on smaller salaries. They can, and I think again, if you go back to 2000 when I started, we would interview people with MBAs and ask them questions about private equity, and they really, you know, what's the difference between venture and buyout, and you know, they couldn't answer, but now it's taught in school. So I think, you know, part of the problem now is probably being a tweener. I mean, I think there's a lot of pressure on the firms that don't have those resources of the big firm, but you know, aren't as nimble as a small firm. But I still think there'll always be a place for newer firms, smaller firms.
And I would echo that. You know, there's beyond just the infrastructure and regulatory increased infrastructure for regulatory compliance. Big firms can, because of their scale, just more efficiently do a lot of different things. But there are going to be individuals at those firms that decide that they would rather be in smaller firms, and properly motivated people will find a way to deal with the increased cost of running a firm.
A smaller firm is probably more likely. You know, we used to always think triple. We want our GPs to put the money out and triple it in 5 years for each investment they make. With a bigger firm, that's not a realistic expectation on the average, especially in this lower return environment. So maybe it's double. But a smaller firm has a higher chance of producing those outsized returns. And so the foundations and endowments that don't have to put out as much money as Sarah and I do favor those smaller firms.
I'll just throw my 2 cents in, which is, and this is, so I've been around, I told you, for like 25 years in the industry. So when I was in the industry and I would be on panels like this, a lot of the older people would talk about, you know, growing regulation, because it has increased, right, over the last couple decades. I don't think there's any two ways about it. And they would sort of lament and say, you know, I'm going to get out of the business. You know, there's too much regulation. It's not worth it anymore. And even when I was in the industry, I'd always look at them and say, what are you talking about? Like, this is the greatest business you could possibly be in. You're helping your clients. I think if you look at McKinsey studies, the average asset manager, I'm not even talking about private equity, the average asset manager has margins of 25 or 30%. Like, who else out there is in a business that's good? And I look at, you know, it's sort of interesting for me for private equity in terms of all we've seen, where we have seen some misconduct and things like that, is I always think, like, to my simple mind, I think, like, the people in private equity, they have the greatest, they're actually adding value for their clients. They're getting paid really, really well. You know, if I was in that position, the one thing I would think to myself as I skipped to work was like, just let's not mess it up. You know, this is the greatest thing going. I'm helping people and I'm doing okay myself. And so my view is on the smaller ones, I still think this is one of the, I tell my son, I have a teenage son, I say, Cole, you want to go be in private equity? Like, that's where to go. Like, that's a great, you know, that's a really good business. That'll be good for you. So for me personally, you know, we're going to share our opinions, I really.
I would love to hire your son, by the way.
So on a serious note, let's make our closing note. Let's not mess it up. All right. I'd really like to thank Drew and Sarah and Margot and Erin and John. You guys have been fantastic. I know I've really enjoyed the time we spent together. I hope it's been useful for you too. Thank you all.
Thank you all.
Thank you.
Thank
Sorry,
you.
it's one sunset part.
Oh, no, that's okay.
I've ever had more fun talking about private equity.
Raging success. Raging success. That's great. I mean, I think, very nice to meet you. Nice to meet you. So your son has a job offer. Congratulations. We're really wanting
That's great. Thank you very much. Thanks for all the help. Thanks for
Oh, okay, yeah, Jason. Sorry. My sister lives about 5 miles from here.
Thank you.
Oh, thank you. Yeah, no.
I actually,
I hope I didn't come across as too cheeky. We'll see. Sure.
Ladies and gentlemen, there's.
I'm not sure. Right outside. Ladies and gentlemen, there is a reception right outside, and then Commissioner Kara Stein will be speaking at 6 p.m. In this room at 6 p.m. And then we have the Capital Formation panel.
Emmerich@calstrs.com.
I was so. I know, but whatever I said, no matter what, I mean, I could have said yes, I still would have. So why wasn't Ryan standing here? Yeah, why did you? We're here in public.
You can give me a call.
I'll give you 5 minutes.
Well, generally I'm going to refer people. Okay, I can do a 5-minute rundown. I always have to try to get people out. I just don't. I thought it was. I have relatives from Prague. You can try. So you're leaving town. I'm staying with my sister tonight. I know when I'm getting back, and I come back, I have 20 you should write, and we also use so we use a gatekeeper.
So what do
It's amazing how many people sign up for it. You know, the thing I didn't get to talk about is I don't think this panel, but
okay. Let's talk.
Having the
Let's
compliance
talk.
retention really
Should I You can do either. I'm hard to get a hold of. I'm trying to see the It's very hard for me to do. Hi. Oh, neat.
I know that regulation is it's
and what, you know,
okay.
Cost is high, but the technology is
there you go. That's your simple way to do it.
now everybody online.
So,
Check in.
that'll go, if we have capital, goes into the
That's
public.
my dad's business.
It won't be so much that we'll be flooded with cash. So right now we have an outflow of about 5 million. So we're about 180. And we have about 5 or 6 or 7 going out in each year, more than we take in terms of benefits we're paying. Right. So this will like close that. It might actually make it a little positive, but it doesn't really give us cash. It just makes us have less leaks.
I just want to say thank you. And, you know, we should follow up sometime. We should do a little article about advisory board practices and stuff. I think that would be a really good thing to write. Yeah, I'll give you a call. Okay. Or I'll connect with you. I know how to connect with you by email. I got enough stuff. But I think you have some good thoughts there. It might be fun to write an article. Okay. So, we need a lot of value added. Sure. Somebody else signs up.
I'm Maggie. I just want to say hi.
You're a long way away. You're a long way away. You've been here.
Well, you have to be at an investment bank first for 2 years. Yeah, you have to work at an investment bank first for 2 years. No, not on the business side. You got to be an investment bank. No, unless you get hired and come to compliance or into legal. It's a non-business. Yeah, correct, exactly. Yes. I don't know. Because I don't do that part. You know. Nice to meet you.
Actually, the fund of funds. So I was wondering kind of what your perspective is on fund of funds. You look at what are the key things? Yeah, other fund managers.
Somebody, actually, I was talking to a friend of mine yesterday, and has for many, many years, and he knows quite a bit of what I'm doing, and he said, what I could never get when I talk to you is as I do. I don't have to do it. But I can describe it to you, and I can do this.
Because they're supposed to be, you know, more familiar and knowledgeable, yeah, that they would actually understand it.
Some of the people. So are you going to dial in? Are you dialing in, or what's who's I got no instructions, so. Dan, who's the moderator? So Dan goes here. How are you doing, Roger? Are you okay? Huh? Fine. How are things? So wait, your family live here? You know what? So your daughter Denver. Wow.
I'll get a couple more water.
Yeah, there should be. There's more.
Yeah. So, I mean, then we'll just hang out at the pool, I guess. Two of the three. The youngest one, she's really hard to travel with. Take that water? That's okay. We can always, we'll work it out. Do we need that water? Is that new? Because I know there's things there's a lot of stuff prior to the game. They do like a fair. Yeah. It might be too much. They should be like good zoos or museums. I like desert. We'll just go hiking or something. Yeah.
It's a big issue, especially here at universities. Most popular one in the room. See a lot. So what's give me all that we have. Give me a holler. Hey, right? 5.07. I say Shaw, I'm ultimately, all right? Because nobody can get in. Nobody can get in. It's exactly it's the OD Barrel. All right? That place is so popular, nobody goes there anymore. But then the business model is really, we make a fortune on the application fees, and then we never actually have to pay anybody anything. We have a great time. Our one shop is only about 75. It's the second smallest. Take care. Thank you, Sarah. Nice to meet you. What do you call your business? So I hear a lot about yeah, it's important. Right. And you're top quartile, and you're just in the wrong sector. So that's the second.
It works, but wow. That's it is. No, I'm so you're watching the absolute.
I'm just take a couple more.
So would you have room for an allocation somewhere in the portfolio for a fund that says, look, we're going to be a private equity, right? And here's our fee structure. Our fee structure, is set up so that if we are anywhere below second quartile, we're going to be very cheap. If we get you
wow. That's amazing. It's okay.
So you got hurdle rates. But those are let's go do this way. I need to finish working out the social programs. You know about hedge fund replication strategies. So suppose I came to you with a family of funds, PE, replication strategies. Yeah, that's right. You'll always stay in that second quartile. And if I'm top quartile, then you think something. I'm going to give you more liquidity. By replicating further. Yes. That's not what I want to sell you something that because it's only a matter of time till you're disappointed. I don't want to disappoint you.
Oh, yeah.
Post the webinar.
Nice to meet you. I'm a colleague of Free Assets.
Oh, okay.
Last year on funding.
Oh, fantastic. All right, yeah, Angelus, they're a client of yours now?
Yeah.
Good.
We worked the spin out. They did another, some of those guys did another firm called. There's one guy.
Sorry, called what? Maiden Lane, yeah, okay. Oh, fantastic.
It was an interesting process.
Well, all of those guys, they're very creative and very interesting.
Yeah.
They're doing something that's like, 15 degrees off. Everybody's doing that.
Yeah, exactly.
So Naval and his team, very, very creative.
Yeah. And I think the hardest part for them was to understand that insurance is very low business. You got it. Because we need it now. Right. We don't even know what you need yet. Let's slow it down. I think it's in the
Have you met the new general counsel? He's spectacular. I've known him for years. He's worked for me over here. He's been general counsel with a fund funds in New York. Just a terrific guy. Really quality stuff.
Sorry, it's my colleague
Mark, how do you do? Pleasure meeting you.
The three of us, two of the three that work together.
Yeah. And you guys ensure me the financial engines. There you go. So, I keep sending you checks and you never send me anything. I like it that way. Let's keep it that way. All right? That's the way I like it.
Can we start helping get checks in?
No. My deal very simply is you're charging me, 2-3% rate online. I'll just keep paying it. We've never submitted a claim. People like insurance for like 12 years. All right. You're making a fortune off of me. Great. I want to keep you guys just, I got to be your favorite client. Never file a claim. Never file a claim.
All right. I wanted to make the connection.
It was really terrific. Pleasure meeting you too. Pleasure meeting you too. Thanks much. Yeah. So, we've been Thanks for joining us.
I get to do this panel tomorrow.
Good. So you want to see what's going to
Venture
happen
capital
there?
conference, so just Sarah Pepper, like a.
Yeah, well, what fun would venture capital be? Gordon, it's a pleasure meeting you.
As John Sword.
Okay. All right, yeah, we do have to talk about that proxy proposal.
Yeah.
Okay. What experience that you had.
Okay.
I'd
So I have some more information for you, which I think you'd be interested in, but I don't know what they're going to do there at the program. Are they going to change their...
Oh, at Harvard?
Yeah. You think they're changing...
What I heard is they're basically shutting down.
Well, didn't your work with...
Daddy, how was your dinner?
Maybe. I have no idea.
Because
I can't control what Harvard does. I can't even control what Stanford does. Sometimes I can't even control what I do.
Okay, all right, okay. Well, let's go back. Yeah.
Excellent, thank you. So, do you have a comment? Yes, great. Great. You finished that.
Needless to say, I don't know. Six is Sarah's time. Yeah. And then they take a 2-second break and then it's the panel. So I think Sarah is next and she speaks for 20 or 30 minutes. I remember.
I signed up for these things.
I put you tomorrow on the VC. They have a VC director college.
Oh, that's right, yeah.
I did last year. I did an ethics and compliance last year. I just sat through the day. So for me, I spent the day, but I didn't have the next day. I had to travel, so I did learn what I could learn, but they don't pay me for it, so I don't feel like I could code anything. No, I did get free breakfast. Well, that's, I know it's cool. But it's not that older soul. Yeah. The last few seats could be cheap. They're really expensive. Yeah. So in the end, who are you going to? Barbara, you think about that, Barbara?
No, that's
Oh.
no, we're much bigger.
I gotta keep track. But you know what? I think that's fine. Because you come back stronger and more. Stuff changes. I asked Joe, why don't you do one graduate for all the existing directors? It doesn't have to have dinner. I said, you have to have cocktails. But you just do an SEC update, compliance, and what's happening. You do an audit committee. You do a legal update on what's happening with everything from IP transactions, something that's legal. Then cyber security would be one day. You have compensation speak on what the new trends on TSR are, and you have someone who was ISS speak. And you put together a day where everyone got updated. I don't know that. They didn't. You suggest burn it down. Stanford's not asking, waiting line for the market. There. I hadn't seen you. And Carlos was out there.
Really good.
So I put Carlos by the phone just so you can kind of help. So are you going to be here for a minute and just answer it if they call? I'm just going to run to the restroom.
Okay, and then can we switch?
Yeah. If you, I can wait a few minutes.
No, it's fine. Go ahead. I'll.
Oh, so does Raja?
And then I'll mute it.
All right. So. Yeah. So you know that someone is. This was a last minute. Yeah. He couldn't get out. So. Do you?
Oh, sorry. I'm just looking at how I mute it.
Any minute. And I don't think you need to mute it. Just have him mute it.
Okay.
He may want to listen.
Oh, of course. Yeah. I'm so used to muting.
Do you think there's going to be any issue with the microphone?
The microphone be needed to pick it up.
Right, but there won't be like a feedback issue.
Well, I can.
He should call in any minute,
yeah,
so we'll be able to test
you
that.
can test a little bit, and then we can have Carlos who's sitting. If you think there might be an issue, just move it closer.
Or further away.
Yeah, he can just try to.
Oh, there we go. Keith?
All right, it's Rebecca Levens and Amanda Packles here from Stanford. We are trying to see if we can get you loud enough. Well, I'll let you do that.
I don't know how to do it.
Oh, okay. Well, let me do it.
We can hear you. We're just testing you with the microphone.
Yeah, right, and I can say I talk too loud.
You're not too loud at all. Are the mics off?
See, this looks like that.
Okay, here we go. Thank you. Okay, try that again. Keith? Keith?
I hear you. It's just I hear a lot of noise in the background.
Okay, perfect. That was good. Why don't you mute your phone?
Okay.
The volume.
Yeah, let me just ask you one question. How many people
have to sit up like this?
Let me call you, because the whole audience is trickling in. So can I call you separately on another line? Yes, let me get a pen. Yeah, what is it? Keith, can you hear me?
Keith?
Yeah, I can hear you.
Okay, why don't you give me your mobile? Uh-huh.
145.
All right, I'll call you right now. Just go ahead and mute the phone you're on now because Commissioner Stein's going to start speaking in a few minutes. But we're obviously not going to mute you. All right, I'll call you right now.
We may have to.
Will you make sure he?
Position winning.
Yeah, so I was just going to have Carlos, who should be just kind of.
Yeah, they actually almost sit on top of it.
So just
somewhere you
so I'll have him. when Keith is talking,
It just needs to be adjusted. It'll come through here. Okay.
When we just tested it, it basically we held it like almost touching it really close.
Okay.
So if you can kind of.
I will do that. And is this mute, not mute? It's on, I'll tell you. Oh, okay, so the red light's on, we're good. Okay, great. All right, thank you much.
This microphone up here. She can even use this.
She'll be coming down, but I can just use this?
Yeah.
Okay, awesome. Do I do anything?
No, it's fine. As soon as it's actually broadcasting now, but you won't be able to hear it right down here because it's muted above us. But
Good evening. Good evening. Good evening. I'm Gina Choi, Director of the SEC's San Francisco Regional Office. Thank you so much for joining us for our Silicon Valley Initiative. We are thrilled and delighted that you are here tonight. Before I introduce our keynote speaker, Commissioner Kara Stein, on behalf of the San Francisco office of the SEC, I wanted to thank Stanford, the Rock Center, Joe Grunfest, Dan Siciliano, Amanda Packel, and their team for working with us on this great event. The Silicon Valley Initiative was originally an idea conceived of by staff in our office who wanted to reach out to the issuer, registrant, and capital raising community here in Silicon Valley. And after attending the Rock Center's annual Directors College last June, several members of our office were inspired by Arthur and Tony Rock's work, sponsoring conferences and seminars and raising awareness of issues surrounding trust in the investment community and at our public companies. Ordinarily, when you hear from our office, it's because we may be starting an investigation or an examination. Not always the best circumstances to exchange ideas and engage in fruitful dialogue about industry trends with your regulator. Through this event, staff in our office wanted to create a means by which leaders at the SEC and stakeholders could discuss key regulatory issues particular to the dynamic and innovative PE, VC, startup, and entrepreneur community here in Silicon Valley. We believe that events like this further our mission of protecting investors and facilitating capital formation. I applaud you for coming and taking time out of your busy schedules to join us as we discuss these important regulatory issues. I wanted to recognize our SVI team, Kristen Snyder, Judy Anderson, Rebecca Lubens, Jeremy Pendry, Bill Salzman, and Carlos Vasquez, who put great effort and thought into organizing this event. And we wanted to thank our panelists from DC, Drew Bowden, the director of the SEC's National Exam Program, Keith Higgins, the director of Corp Fin. They both have been extremely supportive of our efforts. And after a full day of rulemaking for Keith and an out-of-town trip to the Midwest for Drew, they both headed to Dulles this morning in the wee hours. After multiple rounds of de-icing and 8 hours on the runway, Drew was able to make it, and Keith's flight was ultimately canceled a few hours ago, but he will be joining us by phone. We are so grateful for your efforts, and a special thanks to Kristen Snyder, Aaron Schneider, and Carlos Vasquez from our office who heroically took on the last-minute role of understudy. Thank you so much. So on to our keynote. Please join me in welcoming Commissioner Kara Stein. I believe this is her first visit to the Bay Area since becoming commissioner about a year and a half ago. Commissioner Stein was appointed to the SEC by President Obama, and she was sworn in August 2013. Commissioner Stein previously served as legal counsel and senior policy advisor to Senator Jack Reed. Most recently, and during the passage of Dodd-Frank, she was staff director of the Senate Banking Subcommittee on Securities. She served many years as counsel and advisor on Capitol Hill, where she organized and participated in hearings on issues including the evolution of market microstructure, the state of the securitization markets, capital raising, and public offerings, for the role of the accounting profession in preventing another financial crisis. She received her BA from Yale College and JD from Yale Law School. For those of us who have worked with Commissioner Stein, we know how much she cares about the mission of the agency and how strongly she feels about empowering the staff with the tools it needs to protect investors. With that, it is my distinct pleasure and honor to welcome Commissioner Stein.
So let me know if you can hear me. It's an absolute pleasure to be with you today. I want to thank Gina for the kind introduction. I want to also acknowledge former SEC Commissioner Grunfest and now professor. I'm pleased to be here on your home turf. Before I begin my remarks, you've probably already heard this today, I'm required to tell you that the views I'm expressing are my own and do not necessarily express those of the Commission, my fellow commissioners, or the staff of the Commission. I'm very pleased to be with you today and in the Bay Area. I actually arrived on Tuesday, which allowed me to avoid the snowstorm in Washington, D.C., and I've been meeting with many interesting and wonderful people. I want to thank the staff and everyone at the Rock Center who put the conference together. It's been a terrific collaboration, and it's providing all of us with an opportunity to meet and discuss emerging issues affecting capital formation and private funds. So thank you to both for coordinating the conference. I also want to thank the San Francisco office staff for giving me an office away from the office this week. I really appreciate it. So I'm going to tell you a little bit about what I've done since I've been here. On Tuesday, I met with the Financial Women of San Francisco. This organization is focused on women investing in, mentoring, and helping other women. I know that you just spent some time during the previous panel discussing private equity and venture capital regulation. Something to add to the list of important issues facing this industry is the lack of women in private equity and venture capital firms, especially at the senior level. A recent survey found that only 4% of senior venture capitalists are women. This issue has received a lot of attention recently, and I understand that industry groups are focused on it, and I think that people have become aware of both the numbers and of the issue, and are thinking about not only how firms can open up the door, but also create a welcoming environment. So I look forward to hearing about your ideas and positive developments going forward. So as I mentioned, I've been here since Tuesday, and I've been sort of on a nonstop whirlwind tour. On Wednesday, I visited the Runway, a very impressive startup incubator located in downtown San Francisco. Just around the corner from the Runway, I participated in a roundtable on crowdfunding and startup access to capital hosted by the new Startup Legal Garage at UC Hastings College of Law. This innovative clinical program helps train young lawyers to provide legal advice that can help startups get off on the right foot. In visiting all of these places, it struck me how committed this region of the country is to innovation, new ideas, new products, and disrupting old models. So today's conference is an excellent opportunity to talk about both innovation and regulation. How does the Securities and Exchange Commission support innovation? Innovation isn't explicitly part of our mission, but I think the Commission does in fact support innovation through facilitating capital formation. A major driver of innovation in this country has been the existence of a dependable foundation of capital formation rules that, while not perfect, and I'm sure you're discussing that over the next day or so, have allowed companies that need funding to obtain capital to grow and prosper. A key question the Commission is always grappling with is how do we continue to facilitate innovation as business models are disrupted, financial markets change, and technology evolves? How do we ensure that our rules keep pace with innovation? It's very challenging when you're in the government. So part of that conversation that I'd like to have with you today is about that. I want to talk about a few areas at the Commission where I actually see the possibility of new options for capital formation. Just as companies continue to innovate, we at the Commission need to grow, keep pace, and stay out on the edge of such change. We also need to be forward-looking and creative so that we can best carry out our mission. In order to facilitate capital formation, our rules must reflect and accommodate the quickly evolving marketplace. As you all know, the Bay Area has historically been the capital for venture capital, and it remains so today. As of January 2nd, 2015, there were over 1,700 venture capital funds within our San Francisco office's regulatory framework or footprint. We know this from data collected on Form ADV, which is the form investment advisors use to report information to the Commission. That is almost 3 times as many venture capital funds as our next closest regional office. Clearly, venture capital is continuing to thrive in this area of the country. Venture financing has typically been through private investments in smaller issuers. There have been and continue to be amazing innovations hatched right here in the Bay Area. Many of these success stories are attributable in part to backing from various venture capital and PE firms. Twitter, Tesla, Google, the stories are legendary, and all have received funding from private funds from this area. The list of great companies that were initially funded through venture capital is a very long one. As a commission, we of course want to facilitate investment in these types of innovative companies and make venture funds' deployment of capital work as smoothly as possible. At the end of the day, we, like you, care about facilitating capital formation, creating more and better jobs, and nurturing new companies. And there's no better place in the world to form a startup and follow your dream than in the United States, and we need to keep it that way. But the Commission is also focused on some new capital raising methods. Venture capital might not be an option for every company for a variety of reasons. So we need to make sure our securities laws are flexible enough for a wide variety of companies and funding needs. Our securities laws in this area should aspire to provide a variety of funding options that accommodate companies at different stages in their development. I want to discuss some of these options in addition to venture that may be available to smaller and newer companies, and I want to particularly highlight some of the new options that the Commission is considering. Despite the fact that venture financing contributes a substantial amount of capital to smaller businesses, is there more that can be done? As I mentioned, venture funding may not be available for every company. There are a limited number of VC firms. Perhaps your startup focuses on an industry or a sector that's not attracted to venture at the moment, for whatever reason. Maybe your company is in a stage of development that's not appealing to venture. Or it could simply be that you don't like the strings that come attached with venture financing, such as surrendering some management control. The good news is that the Commission is currently considering several new options that will promote and enhance capital formation and help United States companies remain at the forefront of innovation. Some of you in this room helped get some of this passed in the Congress. I'm going to talk about Regulation A+. It could be a potentially very interesting new fundraising option for both small and medium-sized businesses. This provision was part of the Jobs Act passed by Congress in 2012 and would expand upon the Commission's current but little used Regulation A exemption. Reg A Plus would enable companies to offer up to $50 million in a 12-month period without registering their securities with the Commission, as opposed to the current $5 million limit. It would also allow small businesses to raise money from the public with a streamlined approach to oversight by the Commission. Reg A Plus is a creative example of reimagining a capital formation option that was essentially broken. We're still in the process of finalizing the new Reg A Plus, so I can't speak that much about it. Although it's not clear how effective Reg A Plus will be once the final rules are adopted, I'm pleased to see us retrofitting an archaic rule to adapt to a changing marketplace. Changes in technology, in the demands of investors, in our financial markets, and in the needs of small and large companies are clearly disrupting our regulatory paradigm. We're quite appropriately assessing what is working with our rules and what is not. But we need to be continually examining our securities laws to look for opportunities to do the same thing that we are doing right now with Reg A+. As a commission, we need to be as dynamic and as nimble as are the companies seeking to obtain capital and the investors who want to invest their capital. Another new form of capital raising that could plug a gap in the capital formation process is financing through crowdfunding. I suspect most of you are familiar with the concept of crowdfunding, but in essence, crowdfunding allows small companies to harness the power of a community of small investors via the internet to fund themselves quickly and efficiently. Crowdfunding offers the possibility of small businesses raising equity more directly and potentially more efficiently than our current options allow, including providing an alternative to bank lending. In that sense, it is certainly, has the capability of disrupting the current capital formation model. As we all search for ways to allocate capital as effectively and as efficiently as possible, crowdfunding may play an important role. At the same time, equity crowdfunding is a challenging concept for many reasons. It's a new regime. It does not fit neatly into our 80-year-old securities law framework, which is largely focused on operating companies with some history. And with crowdfunding, we are in many ways writing completely new rules and creating new markets out of whole cloth. The excitement over this new form of raising capital also needs to be balanced by consideration of potential risks, both to issuers and investors. It is only going to work if investors have confidence in this new internet marketplace. And the risk of losses to investors, including complete and total loss, is potentially elevated by the nature of the underlying companies. Some argue that the investors most likely to fund these newer and smaller companies may be the least equipped and the least suitable, right, for these types of investments. They're generally going to be non-accredited investors who may be dabbling in an area that's caught their eye, or perhaps a friend has recommended an idea to them. These are unlikely to be seasoned angel investors. In addition, equity crowdfunding may be reduced to a temporary fad if fraud or questions of credibility become part of the mix, or if an investor's rights are not preserved through subsequent tranches of financing. For the crowdfunding market to be successful over the long run, it needs to be a place that is fair, that's effective, and where both investors and companies understand the risks. In this area, our securities laws matter more than ever. Investor protection and capital formation must go hand in hand. As the Commission thinks through innovative and new ideas about capital formation, we also need to think about new and innovative ways to fulfill our investor protection mission. Crowdfunding actually offers a perfect opportunity to do that, and we should be creative. One idea that I'd like to get your thoughts on is whether we can make crowdfunding work better by pooling each class of crowdfunding investors into a fund vehicle. If done right, this could potentially solve the problem of hundreds or thousands of small investors on a company's register, while also ensuring that crowdfunding investors could effectively exercise their governance rights. I know other jurisdictions are experimenting with this idea, but I'd love to hear your thoughts about what benefits and risks such pooling might present here in the United States. Adopting a final crowdfunding rule will be a challenge, but I'm eager to work on it. And I hope that the panel following my talk will be able to get into this issue a little bit. I would welcome your feedback and your thoughts on how to help crowdfunding work as I continue to grapple with it myself. Thank you. That means call me or write me. I am available. And part of coming out here, too, is to say, even though I'm 3,000 miles away, I would love it if you all would communicate with us. You really are the intelligentsia on a lot of innovative and new, capital raising. And if you don't help us, who will? So I've also been saying to people, we're a democracy, and the government is only as good as the people who participate in it. So help us, as we go forward and we struggle with these issues. Help us know how other countries are doing it, how you yourself are doing it on a platform that you've created. Help us. The final capital formation option that I want to discuss is the idea of regional exchanges. Some view regional exchanges as a possible way to help increase secondary market liquidity for smaller companies. In 2011, the state legislature of Hawaii authorized a working group to examine whether a locally focused Hawaii-based stock exchange would be beneficial to support investments in local companies. Other states have undertaken similar examinations. Local or regional exchanges could be a beneficial method for connecting local enterprises to local investors and providing more secondary market liquidity. An exchange focused on venture or smaller issuers might also hold promise. My fellow Commissioner Dan Gallagher has discussed the possibility of venture, exchanges as well. There are a number of questions that need to be addressed, and I support the Commission staff issuing a concept release to get everyone's best thoughts in this area. These exchanges could allow small companies to exclusively trade their shares. Disclosure and other rules might be somewhat relaxed. Perhaps such an exchange could provide a new runway for growth for smaller companies, while also providing the essential material disclosures that investors need. We need to understand also why such exchanges have not worked in the recent past and what, if anything, could be done differently. So again, I'd love to hear your thoughts on that. I want to leave you with a few final thoughts on capital formation. I mentioned some new options that the Commission's considering: Reg A+, crowdfunding, regional exchanges. I also mentioned the tried and true pathway of venture capital. And there are other potential options that I'll have to save for another time. Some of these options for growth will succeed, and some may be lightly used. That's okay. That's to be expected. I always think, but what have we learned? And how do we go from there? That might come from being in the legislature for a long time. It's if the law doesn't work, let's change it. Figure out a better way to do it. But I think we need to keep thinking through this, and we need to keep evolving. The important point is that we all need to be engaged in thinking how to best fund companies given the dramatically evolving financial marketplace. So it's not just happening in the company and the issuer space. In the end, I hope that we will have added a few more options to the palette, and we're going to keep thinking through how to do it better. I tend to think of each capital formation option as presenting a different method of growing with different strings attached. They're always strings. Anytime a company is seeking financing, they're going to have some expectations that come along with the money, right? Whether it's bank lending, venture capital, etc. I already talked about venture sometimes wanting to have a lot of involvement in management. Others may not want the strings attached that come with being a public company, such as quarterly reporting. The capital formation process and the securities laws should be flexible enough so that businesses have a variety of options that can hopefully suit their unique needs while at the same time protecting investors. Many of you in the audience are at the forefront of innovation. And given your backgrounds and your experience, you have a deep appreciation and understanding of what it takes to adapt to a changing landscape. And it's in many ways what makes you successful. I hope that you can help the Commission follow your lead and channel some of that innovative and disruptive spirit. Our regulatory system is 80 years old. I think there's a recognition that we need to evolve in the areas of both capital formation and investor protection to adapt to today's rapidly changing marketplace. At the same time, many of our securities laws have held up remarkably well. The basics are strong and clear, simple. Clear disclosure to investors, good corporate governance, eliminating conflicts of interest, straightforward approaches to fees and cost, transparent public trading markets, being a good fiduciary when managing other people's money, and so on. Time and time again, these basics have led to some of the strongest, most productive companies in the entire world. And I think it's no accident that the American approach to capital markets, including SEC oversight, has been emulated by many. I know that regulation can feel uncomfortable, especially for those who might do the right thing on their own. And we at the Commission should always be innovating to make it work better. But the basics are needed, and they have benefited many market participants. Time after time, we have learned that markets do not effectively regulate themselves. And when basic rules aren't followed, the results are detrimental to everyone. I wear a lot of hats as an SEC commissioner, and there are countless areas to focus on. But please know that fair and effective capital formation is something that I care deeply about. There's nothing more important for our country and our economy than making sure that businesses obtain the capital they need to grow and to create jobs within a marketplace that is safe for investors. So I urge all of you, whether you're a business owner, an academic, an entrepreneur, a student, an attorney, a fund, or just someone interested in capital formation, so capital formation geek, to help us as we continue to explore and discover new options for accessing capital. Only with your input and help can we make sure our options are dynamic and responsive to the marketplace. I look forward to continuing to work with all of you on these very challenging but exciting projects. Thank you so much for your time, and I hope you enjoy the rest of the conference.
Hi, Dan. How are you? Nice to meet you. All right. So give us about 30 seconds here. We'll get settled and jump straight into the next panel.
Hi, Miriam.
I think there's very minor modifications, so it's the same questions that match that, but remember we had kind of blended a few together.
Do I need to unmute this, or is this?
We should. I don't think it's actually muted now. Let's see. Nope. You want to check? Keith, can you hear us? Carlos, I hadn't planned to introduce you, but your senior counsel division of work.
Yes.
I have one thing.
Harvard Law School, and I'm on the law school. Oh, yeah, sorry, on the Division of Enforcement Jobs Act Law School.
Thank you.
Sure.
All right. Okay, thank you. Wow, you are a quiet, eager crowd who definitely wants us to start, and we're happy to do so. We're going to go for about an hour and 5 minutes. We're going to go just a little later than was announced, but we don't want to deprive you of too many of the minutes we have for this particular panel. It's my pleasure to have us discuss the new frontier in raising capital after the Jobs Act. So the keynote was a perfect segue to our discussion. I'm really happy to have this fantastic panel here, and I'm just going to do some very quick introductions. I think a lot of you know these individuals, but just in case not, I think it's worth just a few minutes. Well, first, we have someone who is not physically here, but is tied in on the phone. As you hear, his saga was sad and tragic, but he's kind enough to be here. And that's Keith Higgins, who's the director of the Division of Corporation Finance. We're happy to have him join us by phone. He became the director of the Division of Corporate Finance in May of 2013, having taken that role after being a partner at Ropes & Gray, where he had very substantial experience in securities and corporate law, having advised a very wide range of clients. He is the past chair of the Federal Regulations of Securities Committee of the American Bar Association. No surprise, Phi Beta Kappa undergrad, master's from University of Virginia, and a law degree from Boston University School of Law. I can't harass him because that's an okay law school to go to. I will be harassing a couple of other people in just a moment, however. So we're really happy to have Keith with us today. In a little bit of out of order, I'd also like to introduce Miriam Rivera, who is a very frequent contributor to Rock Center events and issues, in part because she is such an experienced and varied business person, lawyer. She is the only person I ever get to introduce who has count them, 4 degrees from the right school, which is to say Stanford. Bachelor's, master's, JD, and MBA. And I think you did that all before you were like 26 or something crazy. So we're really happy to have her here. She is the co-founder of Ulu Ventures, where she is a managing partner. Her roles have recently changed, and she's doing lots of other things. I'll let you expand on that. But she is, I dare say, famous for her time at Google, having innovated as a lawyer. Lawyers can innovate in a lot of ways, and really contributed fantastically to their kind of current success. And not least of all, she is a fantastically successful investor and advisor and encourager of a wide variety of entrepreneurial activity throughout the community, including, I think, with a lot of the target populations we worry about not being as active in venture capital and other areas. So we're really very happy to have her. I'm also happy to have Carlos Vasquez with us here today. He's senior counsel at the Division of Enforcement at the SEC. He graduated from the wrong law school, Harvard Law School, and he's on the Jobs Act task force with the SEC, and he's going to both contribute and also, I think, make sure that Keith contributes in a positive way. And then my final introduction is my hardest one of all, because it's hard to introduce someone who everybody already knows, even just on site. So as some of you know, when I do introductions, I try to dig up stuff that most people haven't heard, at least recently. So I'm happy to introduce Larry Sonsini. He is often referred to as the Larry Bird of Silicon Valley. And this is a quote that I recently ran across. The go-to guy when you need the thing to work, the ice in his veins, blue-collar scramble for the ball, great teammate, no ego, championship caliber guy. The guy that Fortune magazine once called the most powerful man in the most crucial sector of the American economy. I can only fault him from also graduating from the other wrong law school across the bay, but I will note that he does periodically teach securities law at the right law school, which would be ours, so thank you for that. So with this panel, I think we're just going to kind of jump straight in, and I have an opening question, which is kind of introductory for the concept, and that is maybe Larry, you first, and Miriam, if you want to join a bit. How have recent policy changes, such as the Jobs Act, altered the capital raising landscape for pre-IPO companies in Silicon Valley? I mean, is it really all that we think it is, and has it changed things? What do you think?
It's definitely changed things. It's really improved things. We've gone through an interesting period where capital has become very abundant and at different layers. Now you have angel investors, micro VCs, venture capital firms, growth equity, private equity, and even large institutions that are coming into private placements. So we have an abundance of stratified capital. And the Jobs Act, I think, has made a major contribution in a couple of areas. First of all, expanding the number of shareholders you can have before you become a reporting company. A major change. 2000, provided that no more than 500 are non-accredited. Certainly, the emerging growth company ramp to IPO has been terrific. You can now test the waters about an IPO, which you could not do before. You can talk to qualified institutional buyers and accredited investors. You can have analyst participation in the distribution process, which we couldn't do before. You can file confidentially, quickly, to get input from the staff before you go. And certainly, you have less disclosure in terms of the quantum and quality of your financial statements, less compensation disclosures, say on pay. So the ramp to IPO has really created great flexibility. And quite frankly, it was a very creative move, and I applaud the SEC for it. And then you have, of course, what we're going to talk about today, the ability to do basically private offerings still using general solicitation. The concept of general solicitation has been at the heart of the exemptions under the Securities Act ever since 1933. It always has been a very, very difficult hurdle because once you had a general solicitation, unless you were doing intrastate offerings, you basically were losing your exemptions. No matter the quality of the offerees, no matter the quality of your disclosure or the quality of the purchasers, the SEC has taken that off the table with 506C. But there are trade-offs, and we're going to get into that, and it'll be great to hear from Keith on this. You've heard Commissioner Stein, what we can do with Regulation A+. I'm a bit of a fan of Regulation A, and my first offering I ever did in 1967, believe it or not, was a Regulation A offering. It has value. It hasn't been used. As Commissioner Stein indicated, it's been on everybody's shelf. But now with Regulation A+ coming on the horizon, quite frankly, I see that more exciting than crowdfunding. And then you heard about crowdfunding, which I think is one that we got to debate. I happen to have a lot of concerns about it, and we ought to get into that. But through all of these changes, I think it's important to note that the fundamental tenet of the securities laws, you know, that sunshine is the best disinfectant and electric light is the best policeman, has not changed. And all of the changes, that has not changed. Investor protection, the anti-fraud rules, the quality of disclosure is still there. And that has to be balanced as we loosen up these rules and we get more people involved in the securities business that is a risk business who have less ability to fend for themselves. We've got to weigh that risk. So I'm very encouraged, very excited, but we've got some debates.
Before I jump to Keith to expand on the changes to general solicitation, I'd like maybe Miriam, you're on the other end of the spectrum to a certain extent, right? I know you span quite a bit of it, but can you comment with what you're doing every day, kind of the earlier stage companies, what's going on?
I don't really think that the new allowance for general solicitation has really changed a lot at kind of the seed stage companies where I invest. And I would say that some of the improvements in solicitation have occurred because of the incubation that is occurring in a lot of accelerators and incubators in Silicon Valley. So I would say that general solicitation was much more common, frankly, in the past, and has become less common as the companies going through the incubators are getting more educated about securities regulation, about what is a general solicitation, do they really do it. A lot of the incubators also prohibit the companies from talking about their offerings as opposed to demoing their products. And so I've seen less general solicitation more recently than previously. I also think that the majority of companies are still engaging in private offerings with accredited investors without general solicitation, and they are continuing to do it in the ways that have historically been done through referrals, through people they know, through faculty on campus that suggest they talk to particular people, and that it really hasn't changed that much what you see. Of course, there's still what I would call inadvertent general solicitations as you go through different kinds of events, and the less experienced companies, I think, are more likely to do that. But in general, I've actually seen improvement.
And I think we're going to get into some examples of the inadvertent and maybe expand on what is more possible now as opposed to in the past. But before we do that, Keith, hopefully you can hear me okay. We know that one of the big impacts of the Jobs Act, as Larry enumerated, was allowing companies to raise capital using general solicitation without necessarily having to register with the SEC. Do you mind taking a minute and describing the old prohibition against general solicitation, and then maybe briefly what is now truly allowed under the Jobs Act and Rule 506C?
Yeah, no, I'd be happy to. And interesting that I've got the live feed up on my PC next to the telephone here. As if I'm part. So,
hello, excellent.
Apologize for not being there in person, but at least I'm able to view you. So yeah, for years, well, it's always been the case that you either have to register a securities offering or you need to find an exemption, and typically the exemption that you'd find would be an exemption for a transaction not involving any public offering. And one of the hallmarks of not involving any public offering was the absence of any general solicitation or advertising, so that in order to qualify as a private offering or a non-public offering, you could not engage in a general solicitation or general advertising. And we'll talk more about what that is. Under Rule 506, which is a safe harbor under the securities laws for private offerings, issuers could raise an unlimited amount of capital, unlimited number of accredited investors, and up to 35 non-accredited investors who were nonetheless sophisticated about investing. And accredited investors, most of you know under the SEC rules, are investors who meet minimum income or net worth requirements. And 506 really has been the far and away the most widely used exemption from registration, but at least until 2013, you couldn't do a general solicitation. Fast forward to 2013, so for 80 years, the securities laws lived without being able to generally solicit in a private offering. Along comes the Jobs Act and removes that. It directs the SEC to adopt rules to remove that ban on general solicitation. And I like to think of it in terms of, and I'm sure that this will sound a little bit silly, but you know, the old expression, sticks and stones will break my bones, but names will never hurt me. The notion was that offers themselves wouldn't hurt. It's only the purchases that would hurt. So the purchases were the sticks and stones. The offers were the names. And what Congress directed us to do was remove the ban on general solicitation so long as only accredited investors purchased, and they added on this wrinkle that I think has caused a fair amount of consternation. The issuer has to take reasonable steps to verify that all of the purchasers are accredited investors. And that's one of the slight differences between the existing law and the new law under the Jobs Act. And so that's the landscape. The Commission adopted rules that became effective in I guess 2013, in September 2013, the gloves were off. We haven't seen a lot of offerings filed as general solicitation. Of the 506 offerings that have been done for which Form Ds have been filed, about 90% have been for regular old 506B offerings, whereas only 10% have been for the newer general solicitation. But that's the notion, and of course, general solicitation is a concept a little bit like, maybe it's a little more defined than obscenity, but you sort of know it when you see it, but there isn't a clear definition, and I think that's where some of the uncertainty lies, which I'm sure we'll get into as we talk further during the course of this evening.
So now we have the history, the framing, and what we think is in place now, but we have these ambiguities and potential consternations and risks. So maybe, Larry, could you say what would be your advice to companies right now if they were in fact going to consider general solicitations?
Well, as Keith indicated, right off the bat, we have to recognize that if we're going to engage in the general solicitation, we've lost optionality on almost any other exemption. The private placement exemption should not work with a general solicitation. 506B, 505, the other rules fall away. So the first question is, let's be sure that we know what we're getting into. The other thing to remember is we regulate offers of securities. And the question is, what is an offer? And we've got to realize that a general solicitation could involve an offer of a security right off the bat. For example, you have pitch events where you talk broadly about startup companies. You have demo days where you talk broadly about products and services. Those events could be viewed as conditioning the market for an offering. And the SEC has had a long-standing sound policy that conditioning the market for an offering is itself an offer of a security. So now you have an offer out there. So remember, if you don't have an offer, it doesn't matter if you have a general solicitation. If you do have an offer, general solicitation matters a lot. Then the other thing that I think you have to keep in mind are what are the trade-offs? What are the advantages and what are the disadvantages of it? And I think it's important to recognize, of course, that the general solicitation is only one step in the process because you have an obligation you inherit. And the obligation is you lose optionality here. You don't have a fallback to another exemption. And a condition to doing a financing under 506C, the general solicitation permission, is that you have to take some steps to verify that your purchasers are actually accredited, and we're going to get into that. So you have a job to do, and it may increase cost. It may increase administrative work. I think also you have to realize that there's no exemption from the anti-fraud rules. So the wider the net you go, notwithstanding the fact that your ultimate purchasers may be accredited, you haven't exempted yourself from disclosures of material information. And I think there's always a trap. I have some companies that think about 506C and really think the gloves are off. I can get this offering done broadly without registration, and they're really not off. So I think these are kind of the trade-offs you have to weigh about it. It really is, I think, a very good rule and could be terrific, but I think you have to go into it recognizing you're going to have to check the box if you're going to use it. You can't be coy about it, and you're going to lose optionality in the process.
And so to follow up on that with Miriam, you mentioned a moment ago that you have seen some companies that value using general solicitation. Beyond just asking whether or not you would recommend it generally, what about framing yourself as the VC in that story? Would you have concerns with investing in a company that raises funds with general solicitation generally? Does that raise a flag for you? Does it make you engage in different type of diligence? What happens?
I would, but not because of the category. It's more because it gives additional hurdles that companies have to meet in terms of record keeping and diligence, and anybody who's really worked with startups would be really rightfully suspect that those are actually going to be done, and that the documentation is going to be preserved appropriately. And so from that point of view, I would have concerns about whether that offering could be later subject to rescission, and whether my investment is going to be an actual investment. So depending on how well regulated these are and whether or not there'd be more investigation or enforcement of offerings that actually put a Reg D 506C category, I'd still be a little bit more suspect of it.
And perhaps if I could just riff off of what all the panelists have said so far. The San Francisco Regional Office obviously takes this issue very seriously because of the potential for its use and misuse in our region. We have several members of our staff that are dedicated to, that are part of the Jobs Act task force in the Division of Enforcement. We also have people on the IA and the BD side that are looking for that. And as Keith mentioned, there are filing requirements in terms of Form D where you're supposed to indicate that you're using 506C. Our Division of Economic and Risk Analysis recently ran a report, which I think is on our website, that looked at Form Ds filed between September 23rd, 2013 and September 22nd, 2014, and found that there were 1,697 new 506C offerings in that period, raising $15 billion. So this is obviously a big market. Now, in comparison to the old 506, which is now 506B, there were 18,997 offerings and $465 billion raised. So it's still a very small chunk of the market, as Keith mentioned, but it is one that we do have to worry about because of the general solicitation potentially bringing in a lot more people who shouldn't belong into that offering. So one of the things that we do is we work with DERA and a group called Circa to data mine the 506C offerings in our region and look for ones that we think might be problematic. And we have opened investigations based on that. And we are specifically looking at the issue that we're going to talk about next, which is the accredited investor verification process. But we're also looking for flat-out fraud because back in 2013, we actually brought a case against a company or firm that was gun-jumping the general solicitation rules by saying, we're going to raise a little bit of money now, and we're going to make huge returns. I think they were promising somewhere between 500 and 1,300% gains over 10 years, because we're going to piggyback on the general solicitation when it becomes available. So 21 investors and $400,000 later, we find out that the person is actually using the money in Vegas and paying for his Beamer and going on vacations, and it's just the outright fraud. That's also something that we have to consider in this field.
On that happy note, Keith. Keith, did you want to add something? I think I heard you say something.
Let me jump in, and I assume that somebody gave the disclaimer, the obligatory disclaimer for SEC staff, so I didn't need to repeat it. But as my folks always tell me, clearly I'm only speaking for myself in any venue. But on that point, the notion of general solicitation has always focused on whether or not the company had a pre-existing substantive relationship with the person to whom it was soliciting. And, that pre-existing substantive pre-existing had to be prior to the time that it made the offer. And substantive really focused on the fact, was there some basis that the company had to believe that the person to whom it would be making an offer was the kind of person who had the requisite sophistication in business and financial matters to be able to evaluate. It didn't necessarily mean that the company needed to know right out of the box that the person was an accredited investor. But there had to be a basis upon which you would conclude, yeah, this is the kind of person who would be interested and would have the ability to evaluate an offer of securities. What we're wrestling with now as people try to, the interesting thing about general solicitation, of course, is that nothing has changed about the definition of general solicitation. What was a general solicitation before the Jobs Act continues to be a general solicitation after the Jobs Act. It's gotten a fair amount of heightened awareness about it because people all of a sudden have said, oh my gosh, changed as a result of the Jobs Act.
And in fact, let me maybe drill down on that because it sounds like the inadvertent or accidental general solicitation, therefore, is going to be more relevant. I'm scanning the room, and I don't know if you can see from this angle, but there are definitely some entrepreneurs in the room, I think. And so let's go back to this. We mentioned it, but let's go back to this promotional event / demo day. And can you give us more color around what the SEC looks at and then says, oh, that's fine, it's a promotional event demo day, versus saying, ooh, wait a minute, that might be crossing the line. What can an entrepreneur
I
think
think
about?
If you look, and we actually had some old no-action letters that we've actually encouraged people, if they're uncertain and want to come talk to us about whether we'd provide some guidance on current affairs. But we had some old no-action letters that dealt with venture fairs, which dealt with these types of events where entrepreneurs would get together with people who were interested in investing in companies to where they could sort of kick the tires and see what the companies were doing. Into the event that they had a reasonable basis for thinking were the kinds of people who invest invested in, early stage companies, had the sophistication, the financial and business expertise to look at it. That was not something that I think, at least from Corp Fin's standpoint, I can't speak for my friends in enforcement, Carlos, but at least from Corp Fin's standpoint, that was not the kind of situation we were concerned about. This was not the ad, having a seminar at the local Holiday Inn Express, inviting people to invest in something, a sure shot proposition that was not, that they couldn't lose their investment. So those are the kind of things that Carlos and his folks are after every day of the week. Situations where companies were sort of explaining their business model, their technology, their promise, their markets, and talking about their capital needs, what it was going to take to get to profitability. Those, although probably back to what Larry talked about, would be conditioning the market for an offering of securities. We're sort of on the bubble of whether there was an offering or not, and so long as they were made to people who had some relationship to the sponsor of the event, that it wasn't something held at the Moscone Center where everybody could come in, but it was people who were coming in that did this kind of thing. Those are not the sorts of events that caused us to have a lot of heartburn. Is that helpful at all, Dan?
That's very helpful, and I think I'm going to allow Carlos to add divisional nuance to this. But before you do that, I want to put out a little piece, an extra fact that maybe we can all think about, talk about. So I'm not quite sure what you're going to say about this kind of controlled audience, but the modern twist on that is that in that controlled audience environment, you're the CEO, you're pitching, you're getting these great questions from what are probably perfectly qualified investors, and your head of marketing is sitting in the corner, and she takes a photo of you answering the question, leaning forward, and she tweets, hot startup getting hotter, everybody clamoring for a piece, right? And they tweets that up. And so I want to add that kind of social media twist to this, which is, Miriam's nodding because she's probably seen that happen in real time, right? And so what does that do, even if we were comfortable with the first version? So Carlos, maybe take us through both.
Let me go old school on you, back to 1995. Keith was mentioning a no-action letter, and for those of you who don't know what that is, basically somebody writes into a division at the SEC and says, we're planning to do this, we're planning to follow these rules, would you please not sue us? And the division will write back, if you do this, as you say, we will not recommend enforcement action against you. So it's the no action. So back in 1995, Michigan Growth Capital Symposium wrote in to the Division of Corporation Finance and sort of outlined what they wanted to do. And it's very similar to a venture capital fair. And sometimes what the Division of Corporation Finance will do is sort of pull out the facts that they thought were maybe the most relevant out of the longer letter and say, as long as you're really doing these, that's, we're not going to recommend enforcement action. And in that particular letter, which is May 4th, 1995, once again, the Michigan Growth Capital Symposium, they looked at the fact that they were only bringing in a limited number of companies, I think 20, to present. The audience was sophisticated. They were publicizing through targeted mailings to known accredited investors, as well as very limited general advertising in the Venture Journal. No specific financing details were part of the presentation, and no private placement materials are distributed there. So those are some of the factors that were looked at back then. And from there, you can extrapolate what is it then that you're doing if you broadcast it, if you tweet it. You can commit fraud with a tweet. I think if we haven't gone there already, we're going to get there soon. So I think you could sort of look at some of those general principles and then say, what are you doing with social media, and are you still keeping within that limited audience, or have you just blown it out to the entire world?
Carlos, can I ask you a question?
Sure.
Now that we have 506C, do you think that the staff is going to tighten up the concept of general solicitation for purposes of 506B, where you're not allowed to have general solicitation, or not?
I think, it's interesting because occasionally we go to one of these companies that's filed for 506C after we, done our data mining, and they're like, whoa, no, we checked the wrong box. We are not generally soliciting. That was a complete mistake. We hired the wrong, So I think we're aware of that issue. whether we want to tighten it in 506B or just kind of focus more in 506C, some of that just becomes a resource constraint because with the thousands of Form Ds that are filed, we obviously just can't go after all of them, but I think it's an issue that we'll look at.
And Carlos, let me jump in too, because I know this is stuff that you guys do, and Larry, things like affinity fraud are really bad, and this is where maybe it's, is it a general solicitation when you go to your neighborhood club, where you sort of generally know the people, but you don't have a clue as to what their financial wherewithal is, their sophistication, their financial and business expertise, and you're trying to sell them some securities. That's a problem. That is a huge problem, and it's a much bigger problem than is the situation where, you got a bunch of tiers of venture capital firms coming in to talk to 20 companies that are looking to introduce themselves to the venture capital community.
Yep, exactly. I think a good thing to keep in mind is, let's go back to old school, the private placement exemption. It's still there, a transaction not involving a public offering. And there are several elements that came out of the SEC no action letters and case law about what that is. And in the private placement exemption, it's really about the offerees and not the purchasers. It's the number of offerees you went to, the sophistication of the offerees, the ability of them to fend for themselves. The concept was you didn't have a public offering if you went to a large number of people, provided that you had a basis and a relationship to demonstrate that you knew that they could fend for themselves. They had the knowledge and expertise to assume the risk of the investment. What this staff has done in the Jobs Act, it's kind of given you with 506C the ability to throw all of that out. It's not about offerees. They don't even count the number. It's not about relationships. It doesn't matter. But it comes down to now you're on the hook to verify the purchaser as being accredited, and once you go down the path of general solicitation, there's no way of looking back, and the old rules now are still there. So it's not for the faint of heart just to do it. And I think that I'll go back to these pitch events and these demo days in the country club. There's a lot of conditioning of the market going on by entrepreneurs unwittingly making offers to sell securities because social media is driving that, the web is driving that, these events are driving that, and it's something that we have to continue to pay attention to.
Let me ask Miriam a follow-up on that, which is, in light of this inadvertent activity, do you think entrepreneurs have become a little bit more sophisticated? Are they more aware of it, or are they just excited about the potential but lack kind of a grasp of the details? And even if they know the details, are they going to follow up in the way that you mentioned before?
Well, I do think that a lot of the ones that are doing the demo days in a specific setting like an incubator, those incubators are offering education. I mean, how many lawyers from Wilson would be volunteering to go to StartX or some other incubator to say what the securities regulations are around general solicitation? It's very common for very good professional counsel to be speaking with these young companies and giving them advice about what not to do. Now, I will tell you that you'll go to a demo day and then someone will say, we'll be raising. And I don't know why they would, because I think they have actually been trained. I certainly think that everyone understands that if you're in an incubator, you're likely to be raising in the next 6 months to a year. So there's some amount of conditioning that I tend to believe is relatively going to happen regardless of any training that you provide. But I do think that a lot of the incubators have special event nights where they call them either VIP nights or the mentor nights or other things where the people that are invited in that room are specifically more sophisticated investors. And I hope that the activities that are done between the audiences that they invite to hear the demos are scripted more carefully. I also see them trying to shorten the amount of time, so the fewer words said, the fewer mistakes can be made, and I think that's all good.
Carlos, do you get invited to those events, or is that?
I was going to tell you, you often don't have to worry about SEC enforcement actions rising out of those because we're never invited to those events. And I will tell you that to the extent we are there on SEC business, we do have to announce ourselves, and so there's going to be fair warning.
Got it. And I think another trap that happens is an entrepreneur that's going to maybe do a demo day or a pitch event may think that what I'll do is I'll make a number of cold calls to find out whether you're accredited or you're sophisticated so that I can get a number of people there and yet still have the option to say it was a general solicitation. And I think the staff is very clear on this in no action letters that these cold calls, even to sophisticated investors, probably blows the general solicitation off the bat. So how to manage a general solicitation if you're going there or if you're not going there is critical.
I'm going to shift gears a little and get us onto the new requirements for verifying accredited investor status. I think, Keith, I think we're starting with you on that, and I might turn to Larry a little. So what are the new requirements for verifying accredited investor status? And then I think we're going to talk about the risks if you go down that path. Keith?
Sure. Under 506C, the new rules that permit general solicitation, the issuer is required to take reasonable steps to verify that the purchasers are all accredited investors. And what the SEC did in implementing those rules was it established first that what's reasonable is going to depend on the facts and circumstances of the particular case. And so it's really a principles-based determination that what's reasonable is going to be determined under the circumstances. Now, that's not a terribly satisfactory, bright-line litmus test that you can use. The thought being that if Warren Buffett is investing in your company, you probably don't need to do a lot of diligence to establish reasonably that he's an accredited investor.
I still make him sign something just so I can get his signature. But go ahead.
Right, but the interesting thing is under the old rule, where you were selling to accredited investors, the definition of accredited investors says you either have to be one of these people or the issuer has to have a reasonable basis it reasonably believes that the investor comes into one of these categories. And so even under 506B, you have to have a reasonable basis. And I'm not sure there's a whole lot of daylight between what's a reasonable basis for considering someone to be an accredited investor and what are reasonable steps to verify. I think that you need to, to have a reasonable basis, I like to say you can't rely on naked self-certification where someone walks in off the street in response to a newspaper ad and signs a certification that says, I'm an accredited investor. I don't think that works under 506C. I don't think that works under 506B. And so what we said in 506C, because people wanted a little bit of a bright line, said, look, we'll give some safe harbors. Tax returns, that'll establish income. Brokerage statements, et cetera, along with a credit report, that'll establish net worth. You can even have an attorney or an accountant or a broker-dealer or investment advisor certify your status as an accredited investor. Those are safe harbors, but people didn't like the safe harbors. They focused on them and they said, gosh, that seems onerous. But remember, those are safe harbors, that you don't have to do that. It's going to be principles-based and what's reasonable under the circumstances. Dan, if in your next startup you invite Larry to invest, I don't think you have to ask.
There's no way he gets me.
And that's again my personal opinion about it.
Your comments have prompted thoughtful noises from Larry as you spoke, so I got to let him talk about the risks of doing this.
So I worry about this provision in 506C because the way I read it, and I think Keith agrees with me, the difference from what we were dealing with before, where we had a reasonable basis to believe someone was accredited, that under 506C, the way I read it, you can't get lucky. You can't get lucky.
Yeah, that's absolutely right, Larry. That is
in other words,
right.
under 506B, if they turned out to be accredited, that's great. And so it gave you a lot of room. But C doesn't give you that. There is a step. There is this verification step. It's a new game. And I do think that it's got some risks to it because are you going to upset potential investors when you say, look, I just don't like your answer to the questionnaire. I'd like to see your financial statements. Or I want to talk to your wealth manager. Or have your lawyer call me up to verify that you're credited. Or calculate your net worth for me. That's going to be tricky. That's privacy stuff. That's kind of like, well, I've got a lot of people looking for my money. I'm not going to put up with this. So how we do it is, I think we're going to have to, develop some systems. I do think that the trade-off for general solicitation is the verification step.
And maybe I could add a little to that, because I do actually see issues like this come across where you do have somebody who's not done anything in the safe harbor and instead is going principles-based, and lo and behold, my view of principles-based and their view of principles-based, it's not necessarily the same set of principles. And then you run into a situation where you might have somebody who, through sheer luck, Inspector Clouseau'd themselves into getting only accredited investors, but technically they didn't meet the requirements of the rule, which says you shall take reasonable steps. And if you don't take that, you may not be able to get that exemption, and you may have an enforcement action.
Yep.
There's no question about that. And Carlos, of course, you'll recall, that was explicit in the statute itself. The legislative history was very clear that the reasonable steps were a key factor in that legislation passing and the direction. So the SEC in implementing the rule didn't have a lot of flexibility. But look, reasonable people may always disagree, but at the end of the day, it's an objective standard, and it's going to be, did you take reasonable steps? And Larry, I take your point that there's risk in wondering whether or not you did.
And I think the old reasonable basis is actually facilitated so much by the internet and media that we have exposure to and easy access to. When somebody claims that they've done X, Y, or Z, you can go search on Google and figure out whether it's true or not. Has it been publicly reported in the press? Is it verified by more than one source? Does it match what their LinkedIn profile says? There's so many different ways that you can research people very easily without having to actually get personal information. And I think people would rather talk about sex than money. And so asking them for this kind of information is definitely a big turnoff. I also think, for example, as an attorney, would you want to make the statement that somebody's an accredited investor? I'd rather say, I've looked at their bank statements and they meet the criteria for the last 3 months. Some factual statement. I don't know what other people are going to choose to do, but I think that it's just a higher hurdle because you essentially have people vouching for you, and again, they're going to rely on information that's provided to them, and should they be held liable if they turn out to have given false information and support for these statements?
I'm going to jump
But Miriam, to your point though, I think that you can take credit for that research that you're doing on the internet or whatever publications you're doing as part of the principles-based reasonable steps to verify. I don't think that's mutually exclusive from the reasonable basis. I think it's all part of the same investigation.
Okay.
I'm going to jump us ahead a little because we've got about 10 minutes of talk left and about 10 minutes of questions and answers, keeping with our slightly adjusted timeline. So I'm going to go to you, Larry. You mentioned briefly about kind of the longer period of growth for pre-IPO companies before the IPO. This obviously invites some issues, and one of them is that the shareholders might want intermediate liquidity because it's taking so much longer, employees as well, and we'll invite Miriam to comment on that in a few minutes. But do you see other consequences for this longer pre-IPO timeline that we're experiencing now?
Well, definitely, and I think it has a lot to do with the growth of secondary markets. The combination of the new 12G rule that you can have 2,000 shareholders and 500 of them being non-accredited coupled with the fact that, companies are almost 10 years old before they're going public, as opposed to the old days. Coupled with the fact that they have a lot of ex-employee turnover that own shares. And the combination of Rule 144, which says that if you're not an affiliate, you're an ordinary employee and you've held your shares for more than a year, you can sell them without registration, without the need of an exemption. You have an inherent exemption built into the act. Then you have the company doing financings with huge valuations. We're worth $2 billion. We just did a private placement with a hedge fund that values us at $10 billion, and you got a lot of people run around and say, I'm not going to wait until this IPO. I can sell my shares under Rule 144. I've held them a year, and I got a lot of people that buy them at a $1 billion valuation, and I'm going to get out. So what's wrong with that? Well, it's got a lot of inherent problems in it. One of the problems is if you have a lot of common stock, because trading at these high valuations, remember that the high valuations usually involve a senior security, preferred stock. The common stock, companies want to keep it low price so that the options and equity incentives for employees is still attractive. Well, those valuations may go astray because of a secondary market. It may be hard to get a valuation under the so-called 409A, the tax rule that requires certain valuations. So you have that problem. Then you've got the problem of the fiduciary duty obligation kicking in, and this is really, really important. We talk a lot, and you heard Commissioner Stein talk a lot about doing a lot to be able to raise capital. Quite frankly, I've got another concern that we're not addressing, and it's hard for the SEC to address, and that is what are we doing about corporate governance today? Because a lot of the fraud is in the governance structure as opposed to the actual security offering. So I worry about that you're going to have a lot more litigation by disparate shareholders going against private companies, venture-backed, about breach of fiduciary duties, and quite frankly, venture boards are not well equipped to deal with that. They have related party transactions, they don't have independent directors, so you got exposure there. So that's a problem that's coming. And I think, therefore, this is all great for raising capital, and I'm all behind it, but I think we got to step back and realize that these consequences of developed secondary markets are fraught with potential issues. And last but not least is people are going to demand more disclosure. And ask yourself, if you permit a secondary market, recognizing there's no information out there, what obligation do you have to provide that information? You can make an argument under the Securities Act that if you're not offering the securities, you don't have any. But are you facilitating the offering? And now a lot of companies that try to deal with that are putting in restrictions that you can't sell your stock without our consent to stop a secondary market. But now you got a problem about restrictions on alienation. How valid is a restriction on the alienation of property? And the Delaware law will tell you that you can restrict transfers if it has a reasonable business purpose. Well, are these reasonable business purposes? So, the point is, a lot of activity in this as a consequence of some of these great rules.
We're going to leave people with more questions than answers, but that's good. That's good.
That's good.
Miriam, could you chat? Ideal Investors, you've invested in a lot of startups, wide range of stages and varied levels of lots of success, some success, less success. Have you taken advantage of secondary markets? Has that been something that you focused on? And what's been the consequence?
I have not, mostly because I consider myself a long-term investor. I am trying to invest in companies that I think are going to be potential billion-dollar companies. Many of my companies have been subsequently financed by, the Sequoias and the Kleiners of the world, and I'm betting that they will help those companies to grow into quite large companies. But I have definitely been offered the ability to sell my shares through secondary markets, like a site. The secondary market site, for example, currently has a tender offer of SoFi stock. And my sense is that the price differential between the common and the preferred is quite small on that one. I'm assuming that means that a lot of the common stockholders will want to sell. And it may also help provide for some companies as they move to going public. Maybe that closing that differential is part of avoiding a cheap stock problem. So maybe that is a helpful part of having a secondary market. In terms of the ways that it's more typically done, I would say that as a new round of financing gets done, oftentimes the new investors will offer via the company to buy the shares of prior investors. And so it tends to be a privately done transaction at the valuation that the next round is buying. But we do get calls from time to time from wealth managers for private individuals who are looking for specific companies. And to the extent that you get affiliated in the press with a particular company, like a Palantir in my case, you get a lot of random calls.
Mm-hmm. So let me maybe direct a question at Keith that builds on this thinking, and that is now with the increased flexibility with regards to what isn't counted under the shareholder limit on the Exchange Act for employees' purposes. You've got these longer timelines. What can companies do to handle the liquidity needs of employees who want to sell their shares, and what's some of the thinking that you recommend on the part of these issuers?
Yeah, of course, we in the division don't recommend anything, but the things we've seen.
I tried. Yeah.
And things that we have seen, obviously, particularly for employees. Larry mentioned that where you've held the stock for at least a year, you can freely sell without any restrictions. On the other hand, for employee options, that holding period doesn't start running until the employee exercises the option. And so that's a problem because you also have a tax event when the employee exercises the option, needs to come up with the exercise price and pay the tax. So you need to be able to sell immediately. And so we just had a presentation, the Advisory Committee on Small Emerging Companies had a presentation from Anne-Marie Tierney, who I'm sure many of you know from Second Market, whose company is involved in helping other companies do tender offers for employee and other shareholder stocks where they will, they'll either the company will do a tender or a third party will do a tender for a block of securities offered to pay a particular price for all the securities that are offered. This provides liquidity. We understand in those situations, at least according to Anne-Marie, that issuers tend to provide financial information, so that both buyers and sellers have access to information. That's one thing from the Commission standpoint that we're concerned about private markets is the lack of transparency. The one thing about public markets is that companies are filing their reports and you have financial information. With the absence of financial information, it makes it tough both for buyers and for sellers to make decisions. But we're looking at various ways of secondary liquidity where there's talk about venture exchanges, there's talk about institutionalizing the 4A 1.5 exemption. So there's a lot of activity on our plate.
So I'm going to skip to our last question because I don't want to leave crowdfunding not addressed at all, but I'll plant two items. I think, Larry, you already mentioned that you don't get a pass under all these changes around the anti-fraud provisions, and that's worth thinking about, so maybe we'll get some questions or a chance to address it. And then I want to plant a question that we might come back to, which is, if employees are selling, are there some complex or nuanced obligations on the part of the company if you worry that the employees are selling too cheaply in some cases, and that kind of comes back around. But the question I have is, SEC has proposed rules under crowdfunding provisions for the Jobs Act. Assuming the proposed rules are adopted, and you can make different assumptions about how that happens, but one way or another, if adopted, what impact do you think the rules will really have on fundraising in the Valley? And I'd invite both Larry and Miriam maybe just to give us like a 1 minute or 2 minute view of that.
My view is not going to have a major impact. I think it really has a risk, and that it's going to be ventures that can't get financed. And therefore, it's going to go to the lowest common denominator, and that is the retail investor who's thrilled with the idea of buying a Silicon Valley startup stock, and that the risk of failure is enormously high. It's only $1 million, and it really is only $1 million because if you do another exempt offering, it may be integrated with it, so you blow the exemption. It is true that you have to use an intermediary that's registered with the SEC. There are disclosure obligations the staff is going to propose, so it's not a cost-free approach. So I worry about it. You know, oftentimes we relied upon the intrastate offering exemption, which allows you to sell securities to residents of the jurisdiction where you do business and incorporated, provided that the offering comes to rest in the state. There you can have general solicitation. There you don't need accredited investors. There you can have a large number of offerees. And I just wonder whether crowdfunding is going to go a step too far, and we end up with really unhappy investors who are really ill-informed. However, there is a place for it. I mean, I'm not saying it's not a bad thing. I just think for tech startups that have to scale and have so many inherent risks in them, it's not like a hardware store raising money or someone raising a small business like a floral shop where the risks are more known. These are the troubles with the crowdfunding. I have an open mind to it, but I think we need more work at it.
Miriam, last word on that, and then we'll switch to some questions.
I guess I'm a bit more open to the notion of crowdfunding from a variety of perspectives. So when I was an investor in a company called ProFounder that was actually trying to let your mom and pop businesses be able to finance using in compliance with the state regulations. That was shut down in part because they were ahead of their time. A lot of the things that they did are now going to be permitted under the Jobs Act. I certainly think that there are mechanisms, at least that are proposed right now, that actually provide greater protections for investors than some of what you get in the real world of Silicon Valley. So, the updating annually the investors with financial information. If you're an investor in Silicon Valley and you don't happen to be a major investor, you may have absolutely no information rights to the point of a company going public. And I think that's a pretty common phenomenon here. So my sense is that in some ways it may be more protective than what currently exists as the status quo. I certainly think that the status quo is acceptable in Silicon Valley in part because there is such a high level of sophistication in the investor pool here, whereas I think that more protections may be needed in crowdfunded sites. However, I'm also, as a person that would potentially back a company that wants to get into the crowdfunding space, I think that there are potential problems with regulation that might make the websites liable for the activity on their site. And I think that we probably need something a bit more like a DMCA for crowdfunding sites so that there's some sort of safe harbors if activities that become known as illegal or companies that are doing activities that would be fraudulent should be able to be taken down and not permitted to run their fundraising on a particular site, but trying to make the company itself liable for the actions of a lot of people online is something I'm less comfortable with, and I think that there are other ways that can be addressed.
So we have 5 or 6 minutes left, which is probably just enough time to ask 1 or 2 questions. If you have a question, we've got plenty more, by the way, so don't feel obligated. But if you have a question, please come up to the microphones. We do have, it's not often you have Division of Enforcement, Division of Corporation Finance, right here, able to answer your questions. And if not, we've got a couple more. All right.
Given that lawyers, outside firms, often are the gatekeepers to helping the SEC police fundraising, but given what you said about the vagueness of reasonable procedures, what does a lawyer have to do to give a legal opinion letter that these procedures under 506B have been met? Can they?
We're all looking at Carlos.
I have not encountered a written lawyer letter, so I have not been in a position to test that. I think Larry's point that, what lawyer would actually do that, the comfort level of that. And then I also worry about the parallel opinion letters by lawyers who help pump and dumps all the time. where they clearly have no basis for making the representations they have. So I think we would have to look at that and sort of explore what it is that the lawyer knew. I mean, maybe they have a long-standing client. They, go to a golf club that charges $20,000.
White heart, empty head. Is that a defense?
I don't know. I guess the question would be, would we want to charge the lawyer, or do we want to go after the people who took the lawyer's letter, maybe knowing it wasn't quite on the best ground?
But Carlos, let's remember what the opinion is. The opinion, I assume, is issuer's counsel is giving an opinion to the investor.
Yes.
That the issuer took reasonable steps to verify that the investor was an accredited investor. I mean,
No. That the company had a reason.
Right, that the company had taken reasonable steps to verify that the person to whom the lawyer is giving the opinion was an accredited investor. Larry, I don't know I'm not practicing privately anymore, but I would have thought in that circumstance that a lawyer might say in the opinion letter, for purpose of this letter, we're assuming that the company took reasonable steps. And obviously, if the lawyer didn't believe that the company had taken reasonable steps, he or she couldn't give that opinion. But remember, the opinion is going to the person who is the accredited investor.
Yeah, I'm actually going to jump in. I'm going to make a suggestion because I want to get to two more questions. We're going to hang out here for just a few minutes. So come on up for a moment, and I can't promise that anyone will answer, but I'll stand here. So yeah, no worries. So let's take two more questions. Yeah.
Okay, so when I was growing up, they had the numbers game, which gave you 600 to 1 payoff on 1,000 numbers. So I took algebra in the 7th grade, and I asked people, well, why did you do this? And they said, it's super beta non-correlated return. This was in Jimmy Hoffa's Loco, so these guys were real sophisticated guys. But what happens is it seems like that's what this whole Jobs Act and the crowdfunding is, like Larry says, that a few people will make a bunch of money, but on the overall whole, that there'll be, net losses. This is what the Stanford V Lab said, that they thought that an average person, the average crowd, would lose maybe 20 to 40%. And so, because there's just not sophisticated investors, there's not sophisticated businessmen. And you really need an angel group to do it. So it just seems like the Jobs Act really was created to create jobs, not to get the returns. And so it would say that unsophisticated people really got to be really careful investing into companies. As
people have to realize that
creating jobs.
People have to realize that the venture capital business is a very tough business. They have to realize that the returns in the venture capital business, if you look back over the last 10 years, pale in comparison, which they were when we got this business all started. You have to realize that venture capital is shrinking. How many boards can a venture capitalist be on? The size of the venture capital funds, the size of the money that they've raised is less, all because of risk. And now they're very good people, these venture capitalists. They do their homework, they're very knowledgeable, and if they get a return today of 1.5 to 2x, they're not feeling that bad about it. You drop that expertise out of the system and you go to a crowd fund, of course you're going to increase risks, and that is a concern. And that is a concern I have about what problem are we trying to solve.
Yeah. Okay, thanks.
Last question.
My question is about comparing what the world would look like with some of the regulations that the commissioner was suggesting in the crowdfunding space, like giving a specific investment vehicle similar to like an ETF. That was my understanding for people trying to like invest in a crowdfunding platform for a startup. Like, what would the world look like in comparison between crowdfunding startups and investing in penny stocks? Because we allow for investing in penny stocks, and those are very risky as well. So what's the comparison between those two worlds?
That's a great final question. I'll let whoever wants to jump in give an answer.
No comment.
No comment. Miriam and Larry, I think it's up to you. Unless Keith would like to jump in. Keith? Okay. Yeah. That's fair. Miriam, Larry, what do you think? You're allowed to speculate.
I think we're out of time. I'm not giving that
I
opinion.
think that was a good question, though.
Well, as they say in law, at the law school, we'll leave that as an exercise for the student. Thank you very much. All right. Thank the panel for me. Thank you very much. Good job. Great. Thank you so much. I really appreciate the time.
Have such a tragic story.
So, give me 1 second. Let me thank him and hold your thought. I'm Dan. You are. I couldn't remember. Thank you.
Everything else, he had to stay for that.
Thank you so much. As always, it was great. So I appreciate your help.
Sorry.
So tell me.
Yeah. Hold on, let me go get it. I'll be right back. I brought it down.
The lawyer gave an opinion letter was often requested to do by the investors. It is replied that it is free from registration.
Right, because the answer is. So it seems like that makes him.
Someone's going to take care of you. I'm with it. So I'm
That's changing.
Morning. Yeah, I told Andrew that. Don't worry about it. Don't worry about it. We'll wing it.
I think you're.